Hi, a very good afternoon to one and all, and welcome back to WWTD 2022. My name is Mark. I'm your host for this webinar over the weekend, brought to you by Tiger Brokers. Now, if you have joined us in the morning, we have covered two topics, okay? Firstly, we looked back at 2021, okay? And we also looked at the geographical outlook in 2021. But right now in the afternoon session, we're going to look at two things. First, the Megatrends of 2022, as well as the thematic outlook in 2022. Now, but before I go any further and pass the time over to my good man, Henry, the CFO of Tiger Brokers, I just want to share with you that we here at Tiger Brokers are not just all about work or talking about investment. We are also about play. So very quickly, let me turn your attention over to our experience store at Tiong Bahru. Okay, there you have it, happening today and tomorrow. Okay, Yong Siak Street, 9 a.m. to 8 p.m. Okay, and here we have got the claw machine. Now you might be wondering, what can you get out of this? Well, fantastic prizes only this weekend. Okay, commission-free vouchers. Okay, up $50 to $100 stock vouchers, and we've got 888 Tiger coins. Because guess what? This year is the year of the Tiger, and Chinese New Year is early. I'm Titan, yeah, and we are giving out coins to you, okay? And we've also got Tiger Brokers Merchandise Limited Edition, and last but not least, the Apple AirTag, okay? So once again, that is at 7 Yong Siak Street, okay? We've got participating outlets as well. Chapter 55, we've got Tian's, we've got Old Shifu Charcoal Porridge, and I heard there's free coffee, okay? Free coffee over at Drips Bakery Cafe, all right? Now, as you go about all these different stores and cafe hopping, okay, this weekend with your loved ones, now remember to watch out for our Tiger dolls, okay? Because if you take any photo with them, I heard you can get an extra chance at the claw machine, okay? All right? Now, don't be afraid, okay, if you do have any transportation, we got that covered for you. The good people here at Tiger Brokers have arranged shuttle bus services, okay, from 9 a.m. to 7 p.m., and it's 30-minute interval. These are the details here. Screenshot it. Okay. I'll just give you a few more seconds. All right. And now, before I go any further, just only for this weekend, we've got the Unit Trust Starter Pack. Limited edition only for this WWTD 2022. Investing tomorrow, today. Invest your tomorrow today, right now, exposed to global equity and global bonds. Okay, scan the QR code and get your $50 off today. All right, now, enough of me talking. Let me show you what's happening right at the experience store. I will stop speaking and I'll let you feast your eyes on the screen and our video. Take it away, please. All right, there you have it. That is the experience store for our friends here in Singapore, but for our friends online, okay, whichever time zone you are in, don't worry, we've got you covered as well. Now, very simple question, okay? For the morning session, I gave away 88 coins, all right, for every of the answer that was answered correctly, okay? So all you got to do to participate, if you want to win the Tiger coins, very simple. If you're tuning in from YouTube, okay, you got to download the app first. Okay, for those of you on the Tiger app listening in, congratulations. All you got to do is just answer the question and be hopefully the top 3 or the top 5. Okay, once you get in there, you win the prize. Okay, it's as simple as that. Now, the question for the hour right now for you to walk away with 288 Tiger coins is, where is the experience store happening in Singapore? You got to write down the full address, okay? The question is, once again, type down in the comment section to win 288 Tiger coins. What is the location of our experience store? Okay, now don't worry. This one is mostly for our online audience, because we want to make sure that you are involved too and you can win something as well. Okay, so the first one will get 288. The next second person that answers correctly, 188. And the last third person will get 88 coins. Okay, so good luck. Now, without further ado, ladies and gentlemen, I'll be handing over the time now to Mr. Henry Toh, Chief Financial Officer of Tiger Brokers, to take it away on the panel discussion about the mega trends of 2022. Henry, please.
Good afternoon. A very warm welcome again to the second panel of today. I'm very honored to have two speakers with me. Maybe I'll start with an introduction. Right at the left-hand side, Lim Yun. He's from Lion Global Investors, Chief Investment Strategist. Now, if you have been dialing with us since the morning, you will realize that this is his third appearance. Obviously, today he's our MVP. Right. At Tiger Brokers, we are very grateful for your support for our event. Thank you very much. Right. And right on my left, Jonathan Ang. Jonathan is the founder of 10X Capital. So prior to this panel, we were just having a chit-chat, and he shared with me something. He told me this. He said his vision is to have one investor in every family. Now that kind of jives with me. Financial literacy is a very important part of our life, in our family, and if there's a young guy like 26 years old, by the way, so and he told me he's not married, and he is willing to put forth his career and start education in this, educating people in this area. I think that's a very good leap of faith. Right. Welcome both of you.
Thanks.
Right. Right. I just want to have a discussion about what are the trends we have saw in 2021. Are they likely to continue? What kind of things could we be seeing in 2022? So I'll just highlight a few. Now, I use this term, and I have several of my colleagues asking me what this is. So when I use this term, it's kind of giving away my age. So I was telling people in 2001 to 2002, there was this dot-com bubble. And what was this all about? It's actually about this thing we call eyeball economy. Now, many of you, especially if you are younger than me, you may not know what is eyeball economy. During those times, we have a whole host of companies coming up. And valuations for this company were very high. Their business model predicated on having a platform or having a business where there are many users, and they were basically selling advertisement, right? The actual business itself is always run on a subsidized basis. One very good example was Priceline. Now, Priceline was a company that was offering to help people buy last-minute ticket. So if you want to travel to somewhere tomorrow, you go into Priceline, you throw in the price you want to buy the ticket at. And they were booking like something like 600,000 tickets a year. So when they eventually went for IPO, it was IPO at $18, and on that same day, what happened was that there was this IPO pop. The day closes at $88, right? But Priceline is almost not around anymore today. What happened was that after that, people realized that they have been booking tickets for people and paying a higher cost than what their customers were paying. So obviously, in a long-term basis, these businesses are not quite sustainable, as we can see. Now, the year before and last year, and probably to come this year, we started seeing this kind of business coming on again. I mean, the big one, for example, in Singapore is Grab, right? They lost something to the tune of about 850 million, IPO at about $44 billion. Not likely to turn profitable until 2024 or 25, but we never know. What we know is there's a lot of subsidy into the market. They either subsidize the service delivery guy or the end user, right? Another one is obviously Uber, Airbnb. In China, you can see Kuaishou, very likely to come online, TikTok, etc., etc. And the list could go on. So the biggest fear that I'm looking at this pile of company, very volatile stocks, promise people growth very quickly, but the baseline is an eyeball economy. Again, it's a platform where they rely on multiple users coming in. The service they provide, most of the time, don't give them the revenue to survive. So what happened? They go IPO, or they go to their Series B, Series C, they take the money and subsidize and hope that the business will work 5 years, 10 years down the road. Right. But I also want to share this thing. I happened to meet Lei Jin once. Lei Jin obviously is the founder of Xiaomi. And I asked him, the way you subsidize your handphone, has it resulted to you not being able to price up your handphone today? And he shared this with me. He said, well, if I haven't priced my handphone at that price then, I may not have today. So that's the other flip side. I just want to open this up to both my panelists and see what their views are. So maybe, Lim Yin, you can start first.
Okay, well, as a start, I remember the dot-com bubble.
We are around the same age.
Same age, right? We are quite young, right? Yeah. So during that time, I wasn't in the financial industry yet. So exactly like what you mentioned, as and when there's actually, an IPO, I'll quickly rush to the ATM, at the time to actually subscribe for it. And many a times, it'd be many times oversubscribed, and then the opening price for the first day, you make money, sell it, and you go out for a celebration, right? So that was about it. And we all knew what happened after that period. There was a crash, and then a lot of stocks were gone. So this time round, I think there was a lot of worries in the market, asking, is this another dot-com bubble, right? I think what is important this time round is actually to do, not everything is the same. There are, of course, certain companies where the business model doesn't make sense to us. My job over here today is not to talk about specific stocks. So broadly speaking, those that, in a way, they subsidize their own growth, but without an exit strategy. I think the important thing that you have to ask yourself is there a coherent strategy whereby whatever that are spending in the future will bring you the returns itself, right? So for example, just now you actually mentioned about certain companies whereby, they are spending to expand their network, right? Or to sell a particular products until they reach critical mass. So this, you can think about it as CapEx, or we call it capital expenditure. So it's no different from a company that actually builds a factory or builds a certain retail chain or what have you. So these are considered investment upfront. The important thing that you need to ask is, after beyond a certain period of time, what is the outcome of it? Is this network that you get, this user base that you get, this clientele that you get, is it actually important for you to propagate beyond that? So there are many so-called companies that actually have proven, right, that in the initial stage, is actually investment, right? For example, they will have maybe a lowered fee. Let's say a payment company could actually say that for merchants, zero upfront payment, right? So per transaction is zero, right? Some of the so-called digital payment platforms themselves, right? They use a QR code vis-a-vis, let's say, a Visa, right? In different jurisdictions, different countries, they will charge a different fees to the merchant, and also for settlement, they charge a different fees, platform fees, a different fees. But, when you talk about a digital payment, like let's say a QR code guy, they could upfront charge zero fees. So then you ask, so why are they doing that? It's because it's customer acquisition, right? Because after a certain limit, beyond a certain level, let's say they give themselves 3 years and they build a certain clientele, right? after which the merchants cannot do without them anymore. Then they can go to the merchants, they say, if, let's say, Visa charges you, let's say 1.5%, 2%, I will charge you maybe 1%, right? So at which time they will have been able to monetize whatever services that they are offering. So it's not a simple answer, is this a .com, not a .com, are these companies going to go bust, not going to go bust, purely by the financials in this financial year, or maybe in the next 1 or 2 years. I think it's important for investors to actually to look at the so-called the strategy and also the business plan of the company itself. Do as much research as you can, and if you are convinced that there's actually an exit strategy, at that point you can actually calculate, right, what is the intrinsic value or what is the fair value of the company itself. So in short, I don't think this time round, is actually a so-called like the previous .com bubble. Sure enough, there are certain companies that I think, the business model is not robust unless they make substantial changes to it. If not, they might end up, at a time in point whereby, investors get tired of them pumping money into it and say, I want to see my returns. And how? So at that point in time, probably, that's when the share prices will actually collapse. Yeah. So in short, it's not a so-called a .com bubble scenario itself. There's a whole bunch of companies that I think they are actually on this secular growth trend itself. And in a maybe 3 to 5 years time frame, a lot of these guys would be able to actually to monetize whatever investments that that they actually have.
Right.
Back to you, Henry.
Right. Thank you. Jonathan, for someone who hasn't seen .com burst, but equally savvy with investment, I have to say, what's your view on economies like this?
Right. So I'll say for me, I didn't experience the .com bubble, but I did extensive research because for me, when I first started investing, and I think most of you who are beginner investors, you can relate to this, that you read about a lot of online articles, especially people saying that buying loss-making companies is a big taboo, right? In fact, it makes sense, right? I mean, if you actually create a business of yourself, your own, and if your business is losing money, right, of course that will concern you, right? So what was a defining moment for me was when I saw the world's richest investor, Warren Buffett, investing into this loss-making company called Snowflake. So when I saw that, I was like, it just gave me an aha moment that, wow, if world's richest investor, Warren Buffett, and by the way, he's in his 90s today, if he is someone who is so old and so conservative and, he is okay to let his generals buy into the IPO of a loss-making company, there must be something that I may be missing out, right? So I decided to dive a little bit into this industry after knowing about this. And the first key thing which I think Henry and Lim Yun is talking about is sustainability, right? So I think from this angle, I will have to use some examples, but of course this is for educational purpose and not a recommendation. So I think the main difference between companies like Priceline and some of these loss-making software companies that we see today is that some of these loss-making software companies, they have extremely high retention rates, right? So, if you have 100 customers coming in year one, 98% of them are going to stay with you the next year, right? So in a way, you're just spending money in the first year, and in the second year, as long as they continue staying, you're profitable on a long-term basis. And that is, I think, something that's important. So the key here is to understand that short-term losses can only be justified if it is profitable in the long run. So that is one thing that I think investors can look at, and there is this term they can focus on, which is the lifetime value of the customer. As long as the lifetime value of a customer is more than the cost that you acquire them, then that will make a lot of sense. And one very promising statistic, if you see in a company, is that if your existing customers are buying more and more things from you every single year, that means if on the first year he spends $100 with you, year two he spends $130 with you, right? It shows that this kind of business model is something that's sustainable despite making an upfront loss at the start. So one term that is commonly used in the industry that retail investors can look at is this thing called dollar-based net expansion rate, right? So if that is more than 100%, it means that your customers are actually spending more every single year. So looking at this new way of operating businesses for these software companies, I think that this may not be a bubble because this is truly value creating. And most of these software companies are what maybe most people would have heard of this term called SaaS companies, software as a service companies. And I think as long as it's sustainable in the long term, right, this is something that I think investors do not need to worry. So I don't think that by saying this, it means that all software companies out there are safe. But end of the day, you will still have some software companies that are pre-revenues. That means they have no revenues at all, and then they get very high valuations. And they may not have sustainable business models. So you have to look at it from a case-by-case basis rather than see it as a sweeping view. I think this is something that retail investors can take note of, and this is how we can potentially see the market. Back to you, Henry.
Right, thanks. So what I've been hearing is we don't have to be afraid of these companies, but obviously the same thing to do here is to look at what's the end result, what's the outcome that a company, when they spend this money, what do we want to achieve? I think that's a very good point, because one thing I also noticed that's starkly different from this company these days is that they are basically, or rather a lot of their spending is actually foregoing a revenue that they in theory should receive and to retain customer. I think that's a good point. But having said that, now, a lot of these companies are obviously going to the US. And they're going to the US simply because NASDAQ offers them probably the highest valuation you can get anywhere else, right? So Jonathan, I want to come back to you. Do you think US is still the place to go to for someone who wants some alpha in their investment?
Right. So personally, even though I'm Singaporean, but I truly believe in the innovation of the US. And it's just not, it's just because, I think Buffett has a very great quote, right? If you want to bet against the innovative minds of the US people, then it's going to be a hard bet, right? If you want to bet against that, you're not likely going to have a very great outcome. So I think some statistics that we have is that the net worth over GDP of the US is actually around 600%. So what does this mean, right? It means that the total net worth of the whole country is 6 times the amount that US earns in taxes every single year. So think of it like oil reserves, right? If you have a lot of oil reserves in your country, you actually do not need to import more oil. Same as money as well. If your whole entire population is 6 times worth how much you earn every single year, US is in a way an implied source of capital. They don't need any more additional capital. And what can we infer from this is that they can easily fund innovation in the world, right? They are the source of innovation. And I think this is something that is not a surprise. In fact, most of these big innovative MNCs actually originate from the US. A lot of talented people are actually going to the US and be part of these MNCs. So another thing that I want to share is that there's actually a correlation between the number of productive adults versus the performance of the stock market, right? So right now, in the US, we see the number of prime adults between age 30 to 40 is actually starting to peak, right? And that is why you start to see this revolution in people going to blockchain technology. You have all this software as a service companies that's popping up every now and then last year, and I expect to see more coming this year. So I always believe that as long as a country can continue to have companies that create value, right, real value, not just hype or services that have been done before, but new way of doing things, better way of doing things, more efficient way of doing things, they are naturally going to have more innovative companies, and therefore the stock market will continue going up. So I feel that I still feel very confident about the US because of its talents and also some of its circular tailwinds that they experience in terms of the amount of capital that's in the US. It's just so much money running around there.
Right, thanks Jonathan. Now, I don't disagree with you, but let me just play at devil's advocate and then let's see what we come up with, right? Now, say John, say you are a US dollar holder, I'm a Sing dollar holder, right? And when I issue a $100 Sing bond to you, which you buy from me. Now, what I'm promising today is that 10 years down the road, I will repay you $100 Sing, right?
Yes.
What I don't promise you is what is the exchange rate between your base currency and the 100 Sing dollar.
Yes.
Right. Now, so US being such a big bond issuer, and obviously, for example, China being such a big US debt buyer, investor, goes through that process, right? You know, in my olden days, dollar Sing, it's 3 point something, right?
Yes.
And then when I started working, dollar Sing was back to 1.7, 1.8. And today, dollar Sing is 1.35, right? Now, so if you are a buyer of a long-term dollar debt, right, the only way you can protect or hedge against this exchange risk is to put your money into US and buy a US asset, correct? So that, I suspect, could explain for why there's such an influx of capital into the US, right? Now, with that trend ongoing, US obviously rides the wave. Once you have a bunch of cheap capital coming in, buying up the US asset, you naturally grow, right? But one day the party will stop, right? And if the funds stop coming in, then that is where I think US is not going to go through a downturn, but a cliff drop, right? Is that something you would agree with?
Right. I think as a retail investor, I kind of subscribe to Buffett's kind of point of view, Warren Buffett's, where I don't really dwell too much into the macros, but I truly believe that it is important, especially wanting to know where interest rates are going, right? So for me personally, what I do is that I do my best. I accept the forex risk when I invest overseas, right? Because to me, if I have to worry about forex all the time, then in a way I may be missing out on companies that are growing their revenues at 30%, and inevitably maybe missing out on compounding my money at the rate in which the company compounds internally, right? So forex is something that I accept, it's a risk that I accept, and that I do my best to invest in only companies that are growing at more than 30%.
Right.
So in a way that hedges that potential forex risk where, if the US depreciates, then let's say if I sell my stocks in US dollars, I may lose out in Sing dollars, right? That is also why I do not dwell into dividend companies. I do not buy into US bonds as well, because the returns are around 4 to 5%, and by the time I get taxed on my returns, I may lose out on forex exchange, as what you say. Yeah, so that's just how I think from a retail investor point of view. Otherwise, I feel that if I get too worried, I may be paralyzed, and it's just going to be very hard to invest in that way. So that's just how I see it.
Right. I mean, again, it's not that I disagree with you. I just thought we should also discuss the flip side of.
For sure.
But Lim Yin, I just want to come back to you. I mean, so obviously a lot of people are very pro-US. And I can share with you, trading volumes at Tiger Brokers today, about 70% of our trade goes to the US, as opposed to Hong Kong and Singapore. So the question I want to ask you is, if I take US away from your pie, where else would you put your money in?
Well, can I maybe just go back and maybe address some of the comments that been discussed over here. Actually, I agree with Jonathan that okay, maybe as a start, let me put it this way. I was a fund manager for a global disruptive innovation fund here at Lion Global Investors. So we have identified like 16 themes, or should I say, disruptive themes out there, like your AI, blockchain, the works of it, electric vehicle, it could be AR, VR, all kinds of stuff, right? New energy, genomics and what have you. So there's 16 themes that we have actually identified globally. If you look at the so-called the companies that actually have the innovation that plays in these themes itself, the largest proportion comes from US. Second comes from China. You'll be surprised. And number 3, 4, 5 in the ranking itself is actually very, very far away from the ranking in China. And this includes those in the Europe side, India, and what have you. So this, if you look at, let's say, even in terms of, let's say, unicorn companies, same thing, if you Google in a website itself, you probably will see, let's say last year in terms of unicorn, how many companies there are out there. Again, it will be the same proportion, which means that the bulk of the innovation actually takes place in US, followed by China, then subsequently the rest of the world. So in a very long run, if you are thinking about buying growth in some of these disruption companies, you probably will have to buy companies from the US. But that said, again, it's about timing, right? So the US stocks have done really well for the last 3 years, especially the tech stocks. So the question then is, since they have done so well, valuations are actually at a very high level, right? Then in this year, when you talk about, let's say, a reopening trade, right? Companies reopening, commodity prices could actually go up, interest rate could actually go up. Some of the old economy stocks could actually, at least in the short term, be, on a risk-reward basis, be a better bet than some of these growth stocks. So in a way, investors, professional investors would now be thinking that, why don't I just sell some of these growth stocks or some of these US tech stocks that have already done so well for such a long time? No doubt there will be a long-term growth, but why not rebalance to some of these other themes that we actually have? So the market doesn't go up in one straight line. If you take a 10, 20 years of time frame and you think about it, I'm going to just buy it, sit tight. Well, I do agree that there are, you can actually buy some of these markets, some of these stocks itself. But if you want to maximize your returns, then obviously there are certain times where you could actually trade, or you could actually, have a different kind of makeup in your portfolio itself. So that's for the US stocks. So Henry, you have actually brought up a very good point. In the US for the last 3 years, I think one of the major reasons why it's actually done so well is because of this influx of liquidity in the system. So there are 3 things over here. One is actually the low interest rate. They have cut their interest rate to almost zero, right? You probably know about that. So which means that you want to buy property, your mortgage rate is actually very low. So that actually helps fuel the property prices. So people who feel that, oh, my property is now worth a lot, they feel more gung-ho, they take the money, they go back into the stock market. So it's actually a virtuous cycle. So in the States, you have this very big macro push that has actually helped the asset prices over the last 3 years. So I'm not talking about only in terms of interest rate, but also we call it quantitative easing, whereby the central banks come in and buy bonds from, let's say, from corporates and what have you, right? So from the financial institutions. So these guys have, the property, if they bought their bonds, they have to take the money and buy something else, right? So that free cash goes back into the system itself. It could go into stocks, it could go into other things, right? So that actually fuels the asset prices. Likewise, the US government is also pushing in fiscal spendings and what have you. So you have actually put out a very good point. This year, actually, we are thinking of, the Fed already told you, we're going to stop tapering by sometime middle of this year. It could be earlier, it could be March, it could be April. Subsequently, in this year, maybe third quarter, they're going to start doing rate hikes. It could be earlier than that, who knows, right? Some market participants are saying that it could be as early as, June or maybe what have you. So 3 rate hikes for this year. Next year, there's another 3, 4 rate hikes. And they are talking about quantitative tightening also in between, right? And this is a much faster pace than in the past. So if something that actually is so positive for the stock market gets taken away from it, I think the logical thing to think is that despite all the other things that are the wonderful things that are happening, wouldn't that have actually a negative drag on market performances, at least in the US? So I think the US market would face some challenges. I'm not sure, I'm not saying that it will crash, but I'm just saying that there will be some challenges over there. Obviously, if the growth rate is actually quite okay, if the Fed doesn't over tighten, I think it can actually continue to do well. So just now to your answer, other than US, then if I think that there's a certain risk in the US market, and if I want to reallocate my investments, where do I go to? I think there are a few key trends in this year itself. One of which is actually a reopening trade. So there are some markets whereby they have old economy stocks. Some of them they are caught up in let's say tourism and what have you. And this COVID is actually very bad for them. Growth rates wasn't that great, or maybe the companies aren't growing a lot. But reopening, a lot of these companies are going to see a revival, or should I say, an increase in the profitability itself. And then as such, you could actually buy some of these stocks. So some of the countries out here that are more cyclical in nature could actually be like Singapore is one of them, right? And also maybe even Japan, which is to me quite should I say a dark horse? People used to say. But for the Japanese case, yes, underperformed for so long, valuations are low. It's actually it's very cyclical kind of stock market whereby a lot of the stocks are actually exporters. So when it reopens, global economy grows again, it actually benefits them a lot. So the cyclical stocks could actually have a revival. The second thing would actually be, actually last year, the Chinese market actually didn't perform well. The reason is because of all the new regulations that they put in place in the name of common prosperity. A lot of people actually forget common prosperity. They always think common means that redistribution of wealth. So as such, the private companies would actually see the margins actually being eroded. But the answer is not that. It's common. There's another one, which is prosperity, which means that they want to grow the pie also, where everybody becomes rich again. So this bigger pie, just that how do you cut it? They want it to be more equitable, which means that they want it to be fairer to everybody. So even in the Chinese market, there's investment opportunities, right? So I think that in a Chinese stock market, you could actually see a couple of two things. One, which is all over the world, we are talking about tightening. In China, they are now on the reverse. They are on the loosening. So they do a triple R cut. They did a lending rate reduction. Probably they're going to do more to support the economy itself. So they are on the reverse side of the economy, which is actually going to be positive for risk assets in China. Then the second thing, obviously, is these new regulations that they have in place. Obviously, they're not going to pile on too many regulations, because once they have met their whatever they want, which is actually equitable growth, they don't want monopolistic kind of a behavior. They want to protect, let's say, the gig workers and so on and so forth. Once all those regulations are put in place, they're going to say, no, that's enough, right? The industry itself is regulated enough. It should actually grow down. So with that out of the way, uncertainty out of the way, investors could actually go back into the Chinese market. So that's the second trend. And obviously, on the longer term, we also believe that disruption is here to stay, right? So there's just now I've actually mentioned there are 16 teams out there. I will not repeat over here. So some of these teams could be, I think the hottest team now is actually Metaverse, right? So you can lump everything together. Metaverse, you can talk about Web 3.0. For those who are not very familiar, you can probably Google. I don't have enough time to actually explain this over here. And it's actually linked to blockchain itself, and it's one whole ecosystem. And this is actually revolutionary, meaning that we are at the stage whereby social media was just starting to take off. This is the point whereby the so-called the virtual world or the virtual economy is starting to take off, and you can see new so-called use cases. So, for example, I would say Nike, Polo Ralph, these are popular brands that you guys know. They actually have got events on the Metaverse universe. You have even Times Magazine, right? So they have a museum kind of education events actually on the Metaverse itself. So this is actually to me, a long-term trend, but they have to go through a capex cycle, which means that at this point in time, companies will be investing. So do not be too, so impatient, right? If you look at Facebook already tell you that, this year we're going to invest this amount of money for the Metaverse, for the Metaverse itself. So spending, but no income, right? So don't be too impatient. There's a lot of so-called wonderful investment opportunities out there. I think the most important thing to think about is actually the time frame.
Right.
Back to you, Henry.
Thank you. We actually have time for one question. Something from the audience. Okay, and it's directed at the both of you. What are the other stats that an investor can look at other than a company's fundamental when they are investing in a growth company? So maybe, John, you want to have a go at it first?
Right. So I think main thing that I look at, if I were to put myself in the shoes where I'm very new to investing, I think number one is definitely revenue growth rates, right? So if your company has zero revenues, then please avoid it, especially if you're a beginner, or we don't want to be venture capitalists, especially when we are retail investors. So I just want to make sure that there's revenues and it's growing at least 30%. So that's just kind of like how I look at it. And then I also want to mention there are also qualitative numbers where you can look at, right? For example, when you look into the business, it can be very intuitive, right? For example, growth in customers, right? If your company is not growing their number of customers, then something is wrong. They're losing market share to their competitors, right? Are these customers staying, right? What's the retention of the customers? Of course, this is just stats that are more software companies related, right? But end of the day, each company has their own stats, right? If you look at F&B chain, right? How many stores are actually growing, right? If your stores are not growing, then don't expect the company to grow, and therefore don't expect the stock prices to grow, right? So to me, I'll look at anything that can give me indication that a company can continue growing its earnings or revenues in the long run for shareholders.
Yeah. Right, thanks. Lee
I think that's a very good question, a very tough question. I only have a couple of minutes, so it's
okay.
Almost impossible to answer this question. But then again, from, let's say, traditionally, a professional investor will look at, we call it discount cash flow, right? So, you work out what is the cash flow of the company. Be it, now you lose money, doesn't matter, right? 5 to 15 years later, 20 years later, you give some kind of assumption, what kind of growth you would have, what kind of margins, and then you calculate back, the cash flow. But actually, this method also is a bit difficult because it's very subjective and there's a lot of assumptions in it. So even in the professional investor world, we actually know the stats that we use actually changes from sector to sector. So just now, Jonathan has actually mentioned, let's say, software as a service, right? So software as a service, I think in the US or even in other parts of the world, they actually use price to sales as a kind of a basis. So like what you mentioned, obviously, one thing you have to figure out is the revenue actually growing, right? If actually the revenue is not growing, that's not a growth stocks. Then something is wrong with the business model itself. So the revenue must be growing, but you want to have a relative so-called valuation matrix. So they could actually use price to sales. But not all so-called tech stocks or innovative companies actually have no revenue at all, no earnings at all, right? So even if you look at Google, you look at Apple and what have you, they have got ample cash, they actually have got investment, they have got very good profitability, they've got good profit. So for some of these companies, actually the simple way is actually to look at price earnings ratio, right? So there are various ways that people can look at, not, so it's not one model that fits all. It really depends on the subsector that you're looking at.
Right. I think from the sharing, the word that caught me is there is no one model that fits all. Personally, the way I look at a US stock versus the way I look at a Singapore stock is actually quite different. So I would suggest our audience to first find out what exactly is the objective or what's the underlying they're looking at, and over the next couple of sessions, you can continue to pop the question across to further delve into your answers or the answers that you want to.
Yeah.
Right.
Henry, can I share maybe some opinion on how I think retail investors can navigate the space, when it comes to tightening of QE and everything, which I think you mentioned really great pointers. So I think for me as a retail investor, I think it's very important to understand how a rise in interest rates will actually affect stock valuation. So I will just keep it short. When interest rates increase, valuations will drop, right? So for me as a retail investor, I don't think that I'm as smart as you to always be at the forefront to understand whether if interest rates are going to go up 1%, 2% the next year or the following year. So for me, when I do my calculation, I just assume that interest rates are at 10%, right? Because that's the minimal that I want, right? The minimum returns that I want in my investments is 10%. So that's kind of like the hurdle. So when I do my calculations, I assume for the worst, which is 10% interest rates / inflation rates. And if I can still get a fair value on my companies, then I will feel very safe to actually enter into it. And I think as a retail investor, I'm not saying what you're doing is wrong. You talk about cycling into industries that will actually recover from COVID, right? I feel that for me, I prefer to just stick through growth companies because I think most people actually have a full-time job, right? And I'm just, for me personally, I may not be confident to actually follow through and be at the top of these industries, especially cyclical industries, which can be very complicated, right? When is property going to come back? When is, for example, the oil industry going to come back? No one knows, right? So I prefer to stick into evergreen or what I call industries that have perfectly strong circular tailwinds. For example, I think you spoke about Metaverse. I think it's very clear that Metaverse will keep growing easily for the next at least 3 to 5 years, right? Tech companies are going to grow 3 to 5 years. It's not going to be a surprise, right? But in terms of the oil sector, the property industry, I'm not too sure, right? And I do not know and I'm clueless. So I think at the end of the day, you can stick with something that is within your circle of competence. I think that's the most important. And unless you're in the industry yourself, and then I think it's okay if you want to go into these cyclical industries. If you are, let's say, working in the property industry or if you're in the oil and gas industries and you know the swings, the downturns and upturns very well. Yeah, so that's just how I think about it if I want to keep things simple. Yeah.
Thank you, Rajan. Well, and to our audience, again, the two experts have shown us how they invest, where they invest, and how do they look at investment. So from my end, I continue to hope that with this information, 2022 will be easier for you. And that is exactly what WWTD 2022 is trying to achieve. Thank you to the panelists. Very much appreciate your support for the event. Thank you very much.
Thank you.
Thanks for having me. It's a pleasure to talk to the both of you. Yeah.
All right, that was a really insightful panel discussion about the megatrends of 2022. We hope that all of you tuning in live on our YouTube as well as our Tiger app, you've been blessed by that very insightful panel discussion. Now, moving on, we've got Koh Hui Ju, Senior Director, Sustainability Office from UOB Asset Management as well. Welcome, Hui Ju. Now, we're going to be talking about right now ESG, just the beginning. Just to explain what ESG is for our audience that maybe just starting out on an investment journey, it is environmental, social, and governance. All right. So, Suiju, the very first question here is: what are some of the key highlights in the ESG space that happened last year, 2021?
Thank you, Mark, for having me
Pleasure.
here. It's a pleasure to be here, and a very good afternoon to everyone here.
Yes.
Yes, last year was really, in fact, a very exciting year for sustainability.
Yes,
we have actually seen greater promises from a lot of the nations across the world. Personally, to me, I think the more key or particular key event that we have in last year was actually the COP26 itself. In the COP26 itself, we have actually seen more pledges from the nations across the globe itself. We have, for instance, the Global Methane Pledge itself. We have actually more than 100 nations actually pledging to slash global methane emission by 30% by 2030.
That's very significant.
Yes, and also in terms of deforestation pledge itself, we have actually nations that represent 85% of the world's forests actually pledged to end deforestation or even reverse deforestation by 2030 as well. And of course, not forgetting the coal pledge. The coal pledge, you've seen developed and developing countries actually pledge to phase down, some even phase out coal by 2040. So other than the pledges that we have seen, there's also greater country commitments that was actually seen. The significant ones that we have here is probably the US and the China that actually came out together to actually say that to renew the commitments towards combating climate change.
I see.
And even though, yes, there's a lot of talks about there's no concrete plans being laid out, etc. But I think to have two super economic power coming together is definitely, we are going to see some meaningful changes to come.
Yes, that's right. It always takes the bigger ones to start first, in a sense. And then after that, the smaller ones follow suit. Not saying that Asia is small, but moving on now to Asia. What about Asia's commitment to do this?
Asia, definitely. We will actually see that they have done actually more in terms of sustainability.
Oh, interesting.
Yes. So in Asia, we have the heavy polluters like China and India. And China has actually said to peak its carbon emission before 2030. And India, which is another bigger polluter here, has actually pledged net zero target by 2070. So I think that is the two heavy polluters within Asia itself. In the ASEAN space, we are also seeing nations doing a lot. We have Indonesia, which looks to phase out coal by 2040. We have Thailand, which has actually affirmed net zero target to 2065 instead of 2070. Other than that, Vietnam as well. Vietnam has actually announced net zero target and also phasing out of coal by 2050. And also closer to home, Singapore. Singapore has actually reaffirmed that it will actually meet its net zero target before the end of, in the second half of this century itself. There is also talks to revisit some of our climate targets. And especially, I think everyone will be very familiar with the Singapore Green Plan 2030. So that was one of the key plans that really iron out, or rather lay out, outlines detailed action plans by ministries and also the big corporates to help Singapore achieving the net zero target as well.
That's very interesting and very heartening to hear that many nations have that commitment, or at least that plan, right, to better the world for the next generation and the generations to come. Now, with greater awareness brought about by all these events and initiatives and commitments, it also brings about more greenwashing, right, Viju? Now, what are your thoughts on this? Help us understand, especially our viewers who might be new to this whole ESG thing. What is greenwashing?
Basically, greenwashing is more of a company misrepresenting themselves in terms of how environmental sound they are or how ESG compliance they are. They tend to kind of puff up themselves, saying that I'm actually very green. But to the end investor, yes. So there is this risk of running greenwashing. In fact, two main drivers that has actually led to this, in my opinion. First is probably the short lack of standardized methodology. So there's actually no framework so far in the sustainability space. So unlike the credit space where you have actually kind of standardized methodology by rating agencies, which we are very familiar, the international rating agencies, Moody's, S&P, and Fitch itself. But in the sustainability space, actually, there is still no such recognized. We are actually moving towards that direction, but we are not there yet.
Takes time.
Yes. So that actually gave rise to a tendency of greenwashing.
I hear you.
And also in Asia itself, a lot of Asian companies are actually not covered by the companies, by the providers itself. So that again will be another loophole that companies will trying to puff up themselves in terms of how sustainable they are.
I hear you. Okay, Huiju, that sounds like there can be a potential problem, but what can us investors do, as well as the audience, help us understand what role can we play in combating this greenwashing, so to speak?
Yes, so in terms of greenwashing-wise, there's definitely safeguarding against the greenwashing.
Yes.
We have seen regulators coming in. For example, on the international space, we have the International Sustainability Standard Boards, which actually try to harmonize in terms of how companies report their sustainability. So that is one important, even on the country level and also on ASEAN level. So in terms of ASEAN level, we have actually recently heard about the Asean Taxonomy. So the Asean Taxonomy, which actually seeks to align regulations and also standardize in terms of disclosure. Singapore, Malaysia, Taiwan, Hong Kong, these are some of the country-specific regulators which have actually put in some frameworks. Singapore in particular, we have the environmental risk management, which MAS is looking to probably conclude some first round of conclusion to see how companies or asset managers can do to harmonize or standardize the reporting in terms of their sustainability investment.
And we see as well Malaysia, Taiwan, and Hong Kong as well.
Yes.
Safeguarding against.
Correct. And for me, I was think that for investor itself, investor probably need to read and learn more in terms of what is sustainability, what constitutes sustainability. Because in that way, then you will be able to actually identify whether that is really a right investment that you are going in.
I hear you.
Yeah.
Okay.
So by going into by going into let's say darker green products, maybe that will be one easier way for investors to safeguard against greenwashing.
Okay.
And the other thing is maybe the best or the easiest. I wouldn't say the best. The easiest for them to have a peace of mind, investors, is to delegate out to the fund managers who are like myself, who is actually looking at sustainability day in, day out.
Yeah.
So that will be an easier way because we are actually looking at companies bottom up, really how material is the sustainability efforts that they have actually put in. Are they really doing what they are advocating?
I hear you.
In that sense.
So help me and as well as help our audience understand that for yourself, what are some ways you identify or you in a sense, combat this as an investor yourself? Or as you manage as a fund manager, what are some of the steps? This is just throwing you a question out of random.
That's why I was saying that maybe go for darker green products. So darker green meaning that the fund itself probably would have a specific sustainability objective, or you can having the fund doing some quantitative kind of sustainability measures. So in terms of metrics, in terms of carbon emission, etc. So that will be very helpful in terms of really directly you can see what is the impact, what is the contribution in terms of sustainability when you invest in that portfolio itself.
Okay, thank you so much for the insight. And sorry for throwing you just a random question out of nowhere. But okay, very wise words to navigate investment, especially for us investors in this space. What is your view on this new year?
Moving into the new year, I think as more companies are actually, or rather more nations, Asian nations, committing to the net zero commitment, I think there will be changes to the traditional macroeconomic policies that we see. So that's why I think, if I'm not wrong, this coming February, Singapore is probably going to talk a little bit more on the carbon tax. And also I think following that, there will be more and more regulations or reporting standards that's actually put in place for companies to actually follow. So the way you do business, the way you report your financial might be slightly different from here onwards. Yes. And also
more regulations.
Yes, definitely. And in terms of companies, I would say that even whether you are in the whether you are in the dirty industry or not, you have to take sustainability into perspective. So all companies will probably need to retilt their business model a bit to actually bring in this sustainability angle.
In a sense.
And yes,
it has to be incorporated, just a matter of time.
Yes, even for banks, UOB has been doing a lot in terms of sustainability.
Name me a few things, 3 things that you all do, UOB.
I mean, you can always see on the ad itself. We have
you're here for a reason.
Yes, my UOB bank, my chief CSO Eric, who has actually come out and do a lot of webinars. So other than doing sustainability for UOB asset management, other than doing sustainability inside out, we are also out to educate a lot of
push the cause.
Yes,
in a good direction.
Yes, to educate the investors itself. Because without educating the investors, they will not be able to fully understand what they need and what they want to achieve. So I think this is very important. This doesn't bring us profit, but we are doing that as a social purpose.
I fully agree with you, even though it may not bring your profit, but the social impact is great. And it's like we mentioned earlier, it's for the betterment of the generation and the generations to come.
Correct.
Right? Because we only got one world.
Correct.
And it's that world that we live in, especially for our children and children's generation. Okay, now, important question. Just now you mentioned how fund managers can help. How does UOB AM help one to be part of this ESG movement or part?
Yes, for UOB AM itself, we have actually 2 strategies that I'll probably like to share over here.
Sure.
So in terms of maybe before I go to the strategy, I'll probably like to speak a little bit more in terms of the investment opportunity that we see here.
Sure, go ahead.
Because of the changes in the world itself, whereby people or nations are actually moving more towards sustainability, I think there will be a lot of opportunity because people are always focusing on what is the dirty industry, how should I avoid that.
Yes.
But we should also be looking at the birth of new sectors coming out. So for instance, here you actually see quite a few renewables, hydrogen technology, green real estate, carbon capture and storage, green technology as well as green transportation.
A lot of green.
Yes, definitely. But I think I would like to point out hydrogen technology. That is probably something that you or me and everybody should be looking out.
Okay.
We are talking
Maybe
about
for
green.
our audience, Viju,
Yes.
can you just share a little bit what hydrogen technology is?
Yes, in
Because
fact,
some of them may be just beginning this journey on investment. Okay.
correct. Hydrogen
Thanks.
technology is actually a very versatile technological solution that actually leads to, because it very easily fits into the infrastructure, integrate into the infrastructure. You are using green hydrogen, trying to move toward decarbonization. So unlike the usual use of other fuels, you will produce some emission out there. But for green hydrogen, you do not produce the emission.
Yeah.
So that again helps you to move towards the net zero. And the other thing is it's cheap.
Oh.
Yes.
So zero
that will
emissions
be
is cheap.
yes. So that will be something that we should actually look out for in terms of the hydrogen.
You sound
And-
very passionate about it.
Oh, definitely.
I can sense it. I can sense it. All right. Please.
So going back to just now your question on
Yeah.
the funds, the strategies that we have run
Yes.
in UOB,
Yes.
because as a local firm, a homegrown local firm itself, we really see that there is actually very limited vehicles or products that we retail investors can actually participate in, especially in the sustainability areas.
I hear you.
So there's actually two funds that we recently launched. One is a bonds, one is a REITs fund. Firstly, the United Smart Sustainable Singapore Bond Fund.
Yeah.
This fund is actually a main feature focused on Singapore. Bonds that is issued by Singapore, which are actually high quality Singapore fixed income securities. And this fund actually will be managed in line or rather will be managed according to the three core sustainability themes, which we have actually narrowed down to support Singapore Green Plan 2030. So that is very important. This is first of its kind in this market itself, in
Wow.
Singapore itself.
And UOB is the first.
Yes, definitely. So every securities that you bought there, you have to actually kind of map to one of the three themes that we have here. And it will indirectly kind of support Singapore to the contribution
To achieve
towards
this effort.
securing a sustainable Singapore. So Singapore for Singapore, yes, please support this fund. This is a bond fund.
2030
This
vision,
is a
right?
yes, this is a safe fund.
Yes.
But for investors who are actually more a little bit more risk taker,
Yeah.
for me, you can move on to the second idea that I have here, the second strategy, which is a UOB APAC Green REITs ETF.
Okay.
This ETF actually aims to deliver stable returns, dividends, and also contribute to sustainability purpose. Aims to replicate the IH UOB APAC U-Focus Green REITs Index, which UOB has actually created in partnership with SGX and GRESB. And this is, again, the world's first APAC
Very
Green
typical of
REITs
Singapore.
ETF.
Always like to be the first in making.
This is really first, because when we were searching for it, there's really no such a green APAC green REITs in the market. So we think that this is really a very good one.
Yeah.
REITs that give you a constant kind of income,
Yeah.
but yet sustainability.
Yes.
And for
very
every securities that we actually buy in for this fund itself, they actually need to meet at least certain sustainability requirements. So for example, all buildings that is under the this REITs itself has to be like green certified. Yes, so green building certified. So it's not really like by UOBM you think that it's green. No, there is an external certification there. So again, this is a very good one for people who likes a little bit more kick there and get the higher returns. But yes, do
ask
the
you,
purpose.
Viju,
Yes.
throwing you another question, just off the top, which is the body that certifies whether the company is green or not?
There's actually many different organizations which actually certify.
Yeah.
So in Singapore, we will have the one, then we are in the APAC countries, we'll have the others.
Okay.
So all this will actually forms the database, which we work with GRESB, which is a global real estate organization. They are really specialized in really looking into real estate. Yeah.
Okay, thank you so much. Really insightful. And we hope you, the audience, have learned something about ESG and about how we can plan ahead and better protect this world, the only world that we have and the one that we live in. Okay, very quickly, we got a question from our audience, just about 2 minutes left on the clock. Okay, we've got a question here that says, what's your view, Huiju, on the green bubble? Very quickly, 1 minute.
Very smart. I think we have a very smart audience out here. Yes. Green bubble is actually what we have recently seen. Other than greenwashing, green bubble means that there will be a lot of demand chasing after a small pool of assets. That is what we've been seeing. For example, like Tesla, right? Everybody is just running after it because it's EV, is in the right team.
Yeah.
But to combat this, I mean, to have this, actually that might actually lead to kind of overvaluation.
I hear you.
I'm not saying Tesla is overvalued, but I say that will be one possible scenario that we'll probably be seeing. So to combat this, probably for us, we are very fortunate in Asia itself. UOB Asset Management actually has a lot of regional office. We have office in Thailand, Indonesia, even Vietnam.
Yeah.
So we are able to have the local feelers out there.
Yeah.
To really uncover those undercovered or not covered Asian companies. And we are able to find that, actually, in fact, my Malaysia office, my Malaysia colleague actually found a company which is actually very decent in terms of fundamentals and very good in ESG.
Wow.
Yeah. So, but it was not covered by the global data provider.
Not certified yet.
Yes, but a few months later, when they start covering that, investors start to hop onto this.
Okay.
So I think this really is an evidence that having that local outreach there is very important. Yes, yes. So you are able to get that gems out first before others start digging. The other one is on the transitioning companies. Does not mean that you're dirty, I should just exclude you. Yeah. Yes, I think for AM itself, we will actually look a step deeper into it. We actually like transitional company because as long as they are actually being able
to change,
to be successful there, I think the alpha might actually be bigger than what a usual one is.
Wow. Yep. Very, very insightful. Ladies and gentlemen and our audience online, just want to thank Huiju again. Thank you for taking your time off.
Thank you, Mark.
Share with us about everything ESG, sustainability and everything. So, any last words for our audience? One sentence.
I hope everybody should do a part for sustainability, building a sustainable future for us. I think the important thing is we no longer look at just profit itself.
Yes.
Make your money work harder for you. We should go for profit and purpose.
Okay, you heard the lady, profit and purpose. That brings us to the end of our topic here with Huiju from UOB AM Sustainability Office.
Thank you.
All right, the next topic we have here is disruptive innovation, hopping on the bandwagon, okay, by Ong Ai Ling. Stay tuned. Hi, it's me again. Different setup right here, different color. Okay, now we've got with me on my left here. Please put a thumbs up or like or comment down in the comment section. We've got Ong Ai Ling, Portfolio Manager at Lion Global Investors, here to speak with us on the topic disruptive innovation, hopping on the bandwagon. Now, very quickly, what is a global disruptive innovation?
So, yes, the idea of disruptive innovation is actually about investing in companies that will just completely disrupt or disturb an existing ecosystem. So one very quick example that everyone's probably very familiar with, e-commerce. Now, if you think back to when I first started in this industry, and 20 years ago when Amazon first started, retail was very different to what it is today. You've got the very long supply chain. And today, you've got Amazon, you've got logistics network. It's completely disturbing the way that bricks and mortar retail is.
Yes.
So had you invested back then in Amazon, you'd be laughing your way to the bank right now.
Yeah, probably owning a bank too.
Exactly.
Very interesting. So, can you just share with us what are some of the current global disruptive innovation trends this year?
Great. Actually, here at Lion Global Investors, we actually have the Global Disruptive Innovation Fund. So every quarter, and particularly at the start of each year, we spend quite a bit of time thinking through the themes that we want to invest in for this year and the future. So this year, we actually went through and we highlighted 16 different disruptive, innovative themes.
That's quite a bit.
As you can see on the slide, yes. Maybe I'll just explain a little bit about this quadrant, the quadrant system. This is how we like to think about all the themes that we've got, that we're investing in. So there are two axes there. On the x-axis, the horizontal axis, we're looking at the maturity level of the technologies that we're using. So whether it's already fairly mature or not so mature. And on the y-axis, the vertical axis, we look at the infrastructure that is ready and existing in today's society, and the society's acceptance levels of these themes, of these industries. So to give you an example, at the two extreme, right, you see the pink quadrant and the green quadrant.
Yes.
The pink quadrant, we have names with industries like e-commerce, fintech, digital payment, e-sports, cloud computing. So these are all buzzwords that people are familiar with, and it's stuff that you hear a lot about. At the other end, which is the green quadrant, you have basically industries where we are still in the midst of developing new technologies. And also we're in the midst of actually requiring further, you require even more infrastructure build out. So things like, battery storage, autonomous vehicle, quantum computing, so quite far out there. Exactly.
Yeah,
and actually, the advantage of the GDIF fund is that if you look at it, most of your, traditional tech funds would tend to focus on things that are in the pink quadrant.
That's right.
Right? But at GDIF, we like to look over and beyond just that pink quadrant. We actually want to go to the other three quadrants. So we like to look at ideas and industries that are, say, for example, one of the industries that we're very interested in, or one of the quadrants that we like to see ideas from, is the yellow quadrant. Because that actually is a quadrant where you're looking at the technology is mature enough for adoption, right? We're not fully adopted yet, but there's an opportunity to build out that ecosystem. So it's almost like Amazon 5-6 years ago, not quite 20 years ago, where it's quite hard to predict who's going to win.
It's got its footing. It's just growing now.
Yes. So you're just at that tipping point.
I hear you.
Yeah. So EV, electric vehicles, is one of such industries. Yeah. And so for us, just to give the example on electric vehicles, for example, the technology is starting to really pick up. So I don't know if you've heard, like Mercedes has recently announced that they've got a new vehicle that can go 1,000 kilometers in range.
No, I have not. Oh, that's interesting.
Yeah, and Tesla has just mentioned that, announced late last year, that they've now developed a battery that can fully charge in just 10 minutes.
Yes.
If you think about it, that was one of the reasons why I haven't bought an EV yet. I don't know if you've got the latest Tesla.
No, I don't.
But it takes too long to charge.
Yes.
In the past, it was overnight.
Yeah.
Then they reduced it to 1 hour. But 1 hour, who wants to go to a petrol kiosk and queue up and wait for 1 hour, right?
True.
Now at 10 minutes, it's the same as me go pump the petrol and then just pay my money. By the end of that, that's about 10 minutes. I can live with that, right? 1,000 kilometers.
Fast, convenient.
Exactly.
It brings you so many km.
Exactly. So we're at that point now where we're very close to equivalence with the ICE, the internal combustion engine. Exactly. And that's the beauty. And for us as investors, right? I think back to why we're interested in it. It's because there's an abundance of opportunities in spaces like that, right? Where we can invest directly in the auto EV makers, but we can also, and we think opportunities abound in investing in the infrastructure and the supply chain. So I don't know if our Minister Ong Ye Kong, last year he mentioned that we're going to go from 1,700 charging stations now to 28,000 charging stations. And in the next 5 years. And in fact, in Singapore, if you just bought a car this year or last year, and you have to renew on COE in 2030, right? By 2030, he doesn't expect that there will be any ICE, internal combustion engines for sale by that point. Yeah.
I think the idea is that the trend is to move towards a greener world.
Yes.
In that sense,
yes.
that's why these markets are, especially in the yellow quadrant they were sharing with us, that they are on that maybe if quoting you, the 6-year Amazon, the footing is there, and they are going to grow into a more steady company in a sense.
Yeah, exactly.
Now, there's a portion here, the blue portion. Maybe you can share a little bit more on that with us.
Oh, the blue portion?
Yeah, artificial intelligence.
Oh, yeah, sure. Yeah. Those are actually very newer, those are the areas where you actually require new technologies, but you already have the existing ecosystem. So AI, for example, is something that we're constantly improving, right? But it doesn't necessarily require you to have a new logistics system or new network delivery. Whereas like a metaverse, which is quite similar in concept, but it does require you a lot more to have like the infrastructure to build out.
I hear you. Thank you so much for sharing and walking us through this diagram here that you've shown us, Eileen. Now, very quickly, out of this, what are your 2 areas of interest out of these 16? That's very quick.
Okay. Well, there's so many, right? If I look at it, I guess...
Sounds like maybe cars is one of them, EV?
Yes, electric vehicles, certainly. We can, I mentioned earlier, there's quite a lot that's happening there. I think the other one is also the Metaverse.
The Metaverse.
I'm sure you've heard it a lot today.
Yeah, I've
a big buzzword.
A lot, yes. Especially from your colleagues.
Yes, exactly.
Vivian as well. We're having a chat there earlier about it. But this is your time now. Why don't you share with some of our audience? They might not know what is the Metaverse. Maybe for the uninformed.
Exactly.
Yeah.
So the Metaverse, as the fund manager for GDIF, I find the Metaverse particularly interesting because whilst it's a new buzzword that started only late last year, we've actually already been investing in a lot of the stocks that are in there. So if you look at that, that's Meta, which is one of the ETFs out there which supposedly invests in the Metaverse theme. Yes. And that's their top 10 holdings. The green and the blue ones are the names that are already has been in our watch list, in our universe, and the green ones are actually the ones that we actually have invested in. So in some ways, it's actually an amalgamation of many, many different technologies or many different concepts, right? So different people have different ways of defining the metaverse. My preferred definition, and one that I came up with, is that it's an umbrella concept for the digitization of everything, everywhere, all the time.
Okay, hold on. For myself and for the audience, it's under the umbrella concept for the digitization of everything, everywhere, all the time.
So you're always online. You're always plugged in.
Yeah, always plugged in.
Your classic concept idea is like the Matrix.
Yeah. Oh.
Without all the horrors of like killer robots
no,
none of that.
I hear you.
None of those sentient AIs. But another movie that the audience might be familiar with is Ready Player One.
Okay.
Which talks about a computer game universe where you go into this universe and you can feel, you can touch, you can smell. So it's the digitization of all our senses.
Yeah.
The sensory experience. And I mean, in some ways, that is the ideal. In reality, we're somewhere now in Web 3.0. So it's an extension of the internet.
Yeah. I like how you actually broke it down. Web 1.0 read only, Web 2.0 read and write, and now we are read, write, and live.
Yes. So we're now in the world of Web 3.0, 20 years, 30 years beyond dial-up internet, dial-up modems, right? Yeah. We are actually going to be able to live. We're going to be able to play. We work. Yeah. And we actually will, one of the other concepts of the metaverse is the fact of ownership. You can own bits of it.
That's right. I heard about that as well. Very, very interesting. It's just amazing how technology has improved from dial-up when you mentioned that.
Yes, exactly.
And our demands now, we are so pampered for even how fast our phone charges and how long our battery takes us from the start of day to does it last the whole day, even for our phones. This is the same demand we have for EVs as well.
Well, the fact that you're worried about how long your battery lasts for shows you how plugged in we are and how much time we spend online.
How we are so, in a sense, I remember Elon Musk saying that we are like cyborgs because our phone is an extension of self. You know, it's very interesting. So back to the metaverse. Okay, how is the metaverse related to blockchains, NFTs, and crypto? The important question for some of our more, viewers and audience that are a little bit further down the journey investment.
Yes, of course. So interesting you should ask about that because people tend to merge the two concepts together. And I think the way to think about it is that the metaverse in some sense, or some conceptually, a lot of the people like the notion that the metaverse is built upon the blockchain technology.
Yes.
So blockchain in itself is just a standard of technology. And within that, the cryptocurrencies or the coins that you hear people talk about, Solana, Shiba Inu, Bitcoin, Ethereum, those are the more common ones that are out there. It's actually just a medium of exchange. So instead of using USD, SGD, RMB, you use those instead.
Currency.
And the key is because, the metaverse needs a form of exchange. So, if you're playing if you're playing a game that is within the metaverse, you will have that in-game currency. And then that in-game currency can be exchanged for a coin, for a blockchain coin, which can then be exchanged for real currency. The other important bit about the blockchain technology is the concept of NFTs or non-fungible tokens. So non-fungible tokens are a way of expressing ownership of something. So in the same way that, when you bought your first house, you got I think by our times it was different, but back in our parents' time maybe, they got a piece of paper that said, so-and-so, Tanakao got this house.
Title deed.
Yes, your title deed, right? Back in the days
then
of
you laminate,
paper records.
then you keep
Exactly.
between two sheets of paper.
Exactly.
I hear you.
Yeah, and now by our time, it was probably all computerized already, right? So, certainly when I was practicing, it was like that. And then now, you don't have a centralized storage database. So if, which is it, IRAS's, central database was burnt down, that'd be fine because it's all held in the cloud in a decentralized form. So non-fungible tokens effectively is a decentralized form of digital certificate of ownership. And that's important in the metaverse because back to the concept of Web 3.0, where you can read, write, and live. And live includes ownership of things.
And purchase and everything.
Exactly.
I hear you. So just now you mentioned about role-playing games. I think the misconception, or rather the general opinion, is that the metaverse is only for gamers. You know how, especially with the recent release of Spider-Man, in the metaverse and the colliding of the different universes. So what is your thought on that? Is it only for gamers? Are you a gamer?
I'm quite interesting. So I actually started off as an internet analyst, but no, I don't game. As I said to some gamers, you can be a gamer, but you don't know how to invest, or you can be an investor and you don't need to know how to game, or you don't need to like gaming. I do know how to game, but I don't like it. But that aside, yes, it is quite a common misconception that it's only for gamers. I don't think it's only for gamers. I think with any disruptive, innovative industry, you have this group of people called the early adopters. And gamers in this case are the early adopters because they do spend a lot of their lives online. I had at uni some friends who would be having Dota parties. And this is like 20 plus years ago, right? They'll be raving online.
So long ago.
Yes. So actually, in some ways, we think the metaverse started last year. No, sorry, it didn't. It started more than 20 years ago. When I was I think early in my career, I was playing Second Life. I don't know if you've heard of it. It's a very early iteration of the metaverse.
Sounds like Avatar, but online gaming.
Pretty much.
Wow.
So those are what we call the early adopters. But in many ways, it's already touched and hit many of us. So a lot of us these days, we go online, we shop online. When I'm lying in bed, I'm watching videos online, I'm watching Netflix, etc. Right? So and I started like buying VR, virtual reality headsets to test them out. I can imagine a day where perhaps I don't want to go to the cinema. I just don a virtual reality headset and I watch watch a movie, meet my friends, have a drink. So that's how we're all starting to really live and play online. And I'm sure you're aware with the onset of COVID as well, that's really catalyzed the shift to go online.
It's really a catalyst, Everything, last time, just pre-COVID, meetings are usually in person, but look at the stock of Zoom.
Look at what we're doing here today. We're not in, a hotel ballroom speaking to a live audience. We're still speaking to a live audience, and it's online, digitized, and it's always ready. But we're meeting in a virtual reality world. And one of my colleague even was traveling online recently. Yeah.
Traveling online. Wow, that's interesting. Wait, what, in a game? I'm so lost. I'm not a gamer too, I think. I haven't heard of Second Life. But let me just ask you, in the Metaverse, what are the growth opportunities and what are the benefits we can get from the Metaverse? Maybe for some of our viewers that maybe hearing this for the first time, they're wondering, hey, what's this talk, this buzzword Metaverse? How can we actually be part of it? And how can we actually get some benefits of it?
Yes. So maybe if I just give you a little introduction to the map of the Metaverse ecosystem. So I like to break it down quite simply. So I just think of it as three big blocks, right? You have the gateway guys. Yeah. So these are, you see names that a lot of people would have been familiar with, Roblox, Minecraft, Fortnite. These are the game side of things. Then you've got other names that the more forward-thinking of our audience may have heard of: Decentraland, Sandbox, Solanium. So these are the online virtual gateways. Yeah. To draw a parallel to our tech cycle in the early 1990s, right? This would be like your Alta Vista, your Lycos, your Yahoo. These are the gateways.
Wow.
And what's interesting is that the early adopters at that point may not always be the winners. But anyway, let me finish.
I hear you.
Yeah, so those are the gateways. Then the second part is the second part of that is actually the user interface or the content providers and the digital economy payment systems. So they provide the gel to hold all the different parts together. And then the third part that is actually the ones that maybe people are not, it's not names that people are as familiar with, are actually the ones that are operating in the background. Your infrastructure providers, right? Your hardware providers. So tying this back to investment opportunities, I'm sure everyone wants to know how to make money, right?
Why the audience are here.
Exactly. So
the benefits.
Yeah. So I've lived through like the dial-up modem tech cycle.
Me too. We just gave away our age.
A bit embarrassing to
just
to
1
talk
minute
about
on what are the benefits.
Yeah. So during that time, if you think about it, there were basically the guys who benefited the most in a gold rush is not the guys who are panning for gold. It's actually the spade and shovel sellers.
Yeah.
So who are the spade and shovel sellers of the metaverse? I'd like to think it's the hardware guys, the chipset guys like TSMC, NVIDIA, Samsung, Qualcomm, Hynix. Those are the guys who are providing the chipsets. And the reason why I say so is because everyone at the moment, there's a bit of an arms race. Everyone's battling to be the Google and the Facebook. But for every Google, there's an Ask Jeeves, there's an Alta Vista that no longer exists today. Right. For every Facebook, there was a, Friendster, Friends Reunited,
yeah.
all
Google,
these.
There's a Yahoo.
Exactly.
No, Yahoo's
right?
still around. But
Yahoo's kind of still around, right? Only because of Alibaba. But anyway, so for those guys, during this arms race, they're spending a lot on CapEx, they're spending a lot on chipsets, on GPUs, CPUs. And just think about the amount of data that is being, everything that's digitized, this video.
Yes.
How much storage space is that going to need, right? You were expecting 3x the amount of storage just in the next few years alone. So someone needs to build up this infrastructure. So in the early stage of technology adoption, we want to invest in the infrastructure build-up, guys. In the latter stage, then we start to identify the winners. Yeah. And then finally, in the last stage, that's when, when we went from Internet 1.0 to always online mobile phones. Sorry about that just now.
No worries, no worries.
That's when you can start providing things like e-commerce, travel services, and then you have all those, the ancillary services that are built up from there.
Right.
That's when you can invest in your Spotify and your Amazon and Netflix. Yeah.
Well, we have run out of time. I would love to continue this conversation with you, Eiling, but unfortunately, like I say, time's caught up with us. For our audience online, we hope you've enjoyed that, okay? So we want to thank Eiling for her time, and now we're going to move on very quickly to the next topic, okay? And here's the next topic. It is China Consumer, the Gold Mine by Kieran Ho. So stay tuned. All right, welcome back. Once again, different stage, same host. My name is Mark, and in the hot seat, we've got Kieran Ho, Wholesale Manager, Southeast Asia, Fidelity International. Welcome. Thank you for taking the time to join us here on a Saturday afternoon. It's a joy to have you here. Now, we're going to be talking about China Consumer, the gold mine. Okay, very quickly, let's just start you off. The first question, okay, Kieran. Tell me more about Fidelity, especially in the context of investing in China.
I think that's a good question to start off with, Mark. I think when it comes to investing, not just with Fidelity, but for any investor, the most important thing is research, right? Research is the process of filter where you decipher which is a good company, which is a not so good company. And the idea behind active investing is you try to invest more into the companies that are higher quality, good outlook, and less into the companies that are poorer with their outlook and also maybe not so good quality. So at Fidelity, we are pretty lucky because I think this is where we excel, research. And there's two underlying reasons why I think we excel. The first is resources, right? At Fidelity, we hire about 500 investment professionals.
Oh, that's a lot, huh?
Yeah, and out of that 500, about 200 to 300 are investment analysts. And that is really, really key because investment analysts are the ones that go out and find opportunities for clients. So resource is one thing. The second thing is experience. So Fidelity, we have been around for about 50 years, but being more specific to China, we have been investing in China for more than 20 years.
Wow, that's a long run.
Right, so I think that is what gives us our edge. And I think what is helpful is to also show the audience the impact of research. So on this slide here, what you're seeing is the performance of two groups of stocks, right? In blue color, you see stocks in China that are rated by Fidelity analysts, which means our analysts actually like these stocks. And in orange is stocks that are rated sell by our analysts, which means our investment team doesn't really like it. And you can see over the last 10 years or so, the blue color line has been trending upwards, which shows you that when our Fidelity analysts like a stock, rate it as buy, performance of these stocks tend to be good. And on the flip side, the orange color line where Fidelity analysts rate these stocks sell, they don't tend to perform so well. So in short, really, I think research is important when investing into China, and that's where we have our edge.
Yeah, I think it's very key. I think one of your colleagues mentioned, really it's all about doing a research, finding out the quality of the company as well, and the trajectory, and that will help you decide on the sense,
exactly.
Faith. All right, okay, anyway, since COVID in 2019, end of 2019, 2020, and 2021, even right up to now, it's caused so much volatility. Why should investors consider investing in China broadly still?
I think that is one of the million-dollar questions that should be asked today. And I
why is it the gold mine in a sense?
Exactly. It is the gold mine that perhaps nobody is looking at, nobody is digging, right? But I think what we need to do is, first of all, acknowledge that there has been quite a lot of volatility here. Investors today will call it three things, right? Fear, uncertainty, and doubt. So in short, we call it FUD, right? But if we take a step back, right, there's a lot to be excited when you're investing in Chinese equities today, right? So
Such as
as an equity investor especially, what you're always looking for over the long term is growth and economic activity. So on this slide here, you see on the left-hand side, Chinese economic activity over time, right? Over the last 5, 6 years or so, you see a V shape.
Yes.
Right? And that really, really sharp dip that you see there is no surprise, that's COVID-19. So economic activity in China, whether you're looking at manufacturing, services, or employment, right, went down tremendously. I think that's no surprise to anyone. Right? But what we are optimistic about is that the recovery has already started, right? Already come up in a big way and is beginning to stabilize. So we're not out of the woods yet with China, right? But definitely you can see from economic activity, pretty robust, right? The other chart that we have here is quarterly GDP growth. Again, no surprise, that first blue bar that you see pointing down, minus 6.8%, that was
2020.
Exactly. Yeah. That was, I think China was the first one to experience COVID.
Yes.
So they got hit a bit
China
more,
was
a bit first, yeah, right, a bit earlier than everybody else, but they subsequently saw a recovery. If you fast forward to today, latest available GDP data, Q3, when you're talking about the US and Europe, their GDP was about, the growth was about 2.2, 2.3. In China, that number, I think, was 4.9.
Wow.
Right? So even when things
Close
are
to
stabilizing, yeah, exactly, you are looking at double the kind of GDP growth that you're getting versus developed markets. And the other thing that excites investors today, and it's something related to what you mentioned earlier, all that volatility, right? All that volatility also means opportunity when you're talking about valuations. How cheap are things, right? How cheap are Chinese equities today? And if you look at the charts, whether on the left-hand side, on the right-hand side, left-hand side, you're looking at price to earnings ratio. On the right-hand side, you're looking at price to book ratio. Basically, the higher these lines are, the more expensive equities are. The lower these lines are, the cheaper. And you can see orange versus blue. Orange is the S&P 500, so US equities. Blue is Chinese equities, right? And you can see there is a big gulf,
Yes, there is.
right? Which means this chart suggests that US equities are trading quite a little bit more expensive than Chinese equities, right? And it's a little bit thanks to the volatility that we have seen. The yellow color line helps to simplify, right? So if you're comparing or considering investing, in either US or Chinese equities, that is the kind of discounts they're looking at, 30 to 60% depending on how you look at it.
It's very interesting. and I like how the yellow line is there to make things, like say, a little bit more palatable and understandable, digestible for us, the audience. So for those of you online, we hope if you want to take a screenshot of this, feel free to. For any other graphs that any of the speakers, including Kaden, has shared with you, if you want to find them, feel free to just rewind the video and then do a screenshot, of course, after we are done doing this live broadcast, okay? All right, Kaden, moving on to the very next question then, would be going back to the title, all right, which China,
The gold mine.
a gold mine. Right, could you tell us why, if you're looking to invest in China today, why is the China consumer theme worth considering?
Yep. I think there are, again, lots of reasons to consider Chinese consumer theme. And we will start by talking about the shift in the Chinese economy.
Okay.
Right? So for many, many decades, the Chinese economy has been powered by trade, right? Import and exports, especially exports. But over the last 2 to 3 years, I think what we realized is that the Chinese economy is shifting. Right? And they want to shift towards an economy that is driven by 2 engines instead of 1. Right? So one engine is the one that has been driving, that will be trade. Right? So one engine will be trade. The other newer engine, right? Exactly, internal demand. This is something that the Chinese economy will be depending on moving forward. And this is where it starts to get exciting for investors out there that are looking at the Chinese consumer, because most of internal demand will be the spending of the Chinese consumer.
Yes.
Right?
And they are the largest population.
They are the largest population in the world. People always say that if you can sell a $1 toothbrush to everybody in China, you'll be
a billionaire.
Exactly. Right? And if you think about demographic trends, right, you will get even more excited, because when you talk about consumer, whether inside China or outside China, a lot of people will always tell you about the middle class. Right? Why not the upper class? Why not those that are below the middle class? Is because of the willingness and ability to spend. right? So those that are a little bit more wealthy, right, or the top 1%, 2%, 3%, they have definitely the ability to spend.
Yeah.
But do they have the willingness? If I am middle class, right? If somebody who is 1,000 times richer than myself, is he going to buy 1,000 times more cars? Unlikely, right? So they have the ability, but not really the willingness. And at the bottom, those that are less fortunate, maybe not in under the poverty line, right? They have the willingness to spend, but maybe not the ability to.
That's right.
At least not yet, right? And that's why the middle class is so important and so exciting. And if you look at this chart over here, it shows you, or it breaks down the different segments of the Chinese economy in terms of the consumer. So the middle class, which is the middle portion there, which I highlighted in that yellow color box, you can see from 2010 moving into 2018 has grown significantly, and we expect it to continue to grow. Right? So those people who have the ability and the willingness to spend, that lot is getting very big. And therefore, you can say that the gold mine is getting bigger and bigger.
So they are the gold mine, the people.
Exactly.
But we can definitely see the change. Just 8 short years, it's definitely moved up.
Yes.
To the middle class. Okay, now the backdrop for the team sounds well supported, but can we link investment performance to the theme, which is China consumer, the gold mine?
Yes.
Can we?
Yes, we can. Right, so on the next slide, we go straight into the slide. Right, we go straight into the slide, look at the data that's available to us. Right, so what I've done here is plot 2 lines again. In the blue color line is MSCI China, which is the broad Chinese equity index, we can say broadly Chinese equities. And the orange color line is consumer sectors. So consumer sectors, I'm talking about IT, I'm talking about consumer staples, consumer discretionary, and healthcare. If we only invested in these 4 consumer sectors, the orange color line will be the performance over the last 10 years. And here I've updated the chart to the 31st of December 2021. Right, so this performance is in spite of all the volatility that we have seen last year. Right, looking at the numbers here, this 307.154 versus 143.72, I'll simplify it. Basically, if you are invested in consumer sectors, the kind of returns that we've been looking at over the last 10 years or so, about 200%. Blue color line, broad index, about 50%. Still respectable, but I guess...
The difference, 50% and $50 and $100.
Maybe just a 4 times difference. Yeah. So I guess to answer your question, there is evidence just by looking at markets today.
Okay, that's very, very insightful. Could you give us, like you have shown us a lot of very informative graphs that really speak for themselves, and you have explained further to our audience. But any more data? I'm sure not just myself, but the audience online, we're wondering, besides the people, besides what you have shown us, what are the data and details you have that China is the gold mine? Help us understand.
So Mark, I think this gold mine today, we can talk about 3 parts of the gold mine, 3 themes, right? The first theme is premiumization. The second theme is local brands in China, and the third one is technology. Right, so first, talking about premiumization, I think it's pretty intuitive. As the Chinese consumer becomes more wealthy, they demand more premium products. And that is what premiumization is. And to give you an example, let's talk a little bit about autos or cars sales in China.
Sure, we've been talking a lot about cars.
Yes.
The whole morning right up to now.
Today we're not going to talk about EVs. We're going to look at things a little bit differently.
Including the good old-fashioned ICEs.
Exactly.
Sure.
So on the left-hand side, it's showing you the mix of sales of cars in China, right? In layman terms, if you go towards the left-hand side of the left chart, in 2012, for every 10 cars that were sold in China, 1 was a premium car, 9 was a non-premium car. Right? And as the time goes by, you can see the orange color line move up. It means that more and more people are buying premium cars, to the point that if you're looking at 2021, last year, for every 10 cars that were sold, 3 were premium.
Wow.
So this can clearly tell you that in China, it is definitely the preference for premium automobiles.
Spending money.
Yes. And that is the long-term trajectory. What was also really, really interesting is on the right-hand side. On the right-hand side shows you sales of cars, right? Orange color is premium cars, and blue color is generally, right?
Other cars.
The other cars. And what we saw last year...
A dip and a huge rise as well.
Exactly. So that was the COVID-19 situation. So nobody could go out and buy cars, right? So sales for automobiles definitely fell.
Yeah.
But premium automobile sales, it accelerated a lot faster, right? So this is also maybe a defensive nature of premium products, right, that we can speak about.
They want to coax themselves or reward themselves for staying in too long.
Yes.
They want to travel in comfort.
As well, with luxury products.
Yes, with luxury.
Yeah.
I hear you. Okay.
Yeah.
Very informative once again. Yeah. So this is just the cars and how they are used as it's just one of the, I'm sure, just one of the many sectors that are telltale signs of how premiumization is happening in China.
Exactly, Mark. And the second thing that I will go through is local brands.
Okay.
Right. So local brands is also something that has been gaining traction in China.
Yeah.
Right. Before you look at this, all we need to do is ask ourselves, how many Xiaomi products do we have at home today?
I have a few.
I have at least 5, if not 10. And the reason why we buy them is not because they are affordable. Yes, they are.
Yeah.
But it's because they are high quality and in many cases quite innovative as well.
Yes.
Right? So it is quite easy to understand that in China, right, there is a preference for local brands in many sectors already today. So this chart here shows you different types of products. You've got dairy, personal digital gadgets, skincare, so on and so forth.
Yes.
And whenever you see a blue bar, it means that a Chinese product is preferred, one of the top 3 preferred. Right, so in many of these sectors, maybe for the exception of red wine and cosmetics, Chinese companies, Chinese products are the preferred, or Chinese brands are the preferred ones in these categories. So it gives you the evidence or the idea that local brands, more and more today, are preferred by the Chinese consumer.
Yeah, and it's by themselves as well, right? So the Chinese consumer prefers their own products compared to others. I wonder how, if we were to tip the scales, how we Singaporeans would fare for local products.
I think that the chart will look pretty much the same. Yeah, I think the chart will look pretty much the same. Yeah, so I'm guessing, Mark, I guess the reminder or message for our audience is today, if you're looking to invest into the China team, the China consumer team, look out for companies that are local brands, right, and cater to the Chinese market.
Okay.
Yeah.
Thank you for that, Kiran. Now you have shared with us lots of insights. You have shared with us the details, the data, really informative graphs and everything. But here's the key thing. Kiran, do you invest in China?
Yes.
Yes. Okay. Now, important for me and the audience, because we want to know how far you are in this journey of investing in China and how do you even get started? What was it like? Let me just rephrase that. What was it like when you first started this journey?
What was it like when I first started? I think when I first got into the industry,
the gold mine.
You just go for the sexiest, kind of investments, right? So very high tech stuff.
Yeah.
Yeah. And as time goes along, you begin to realize that you can't just read the news and invest on the news.
Yes.
And especially at Fidelity, where research is a really big thing for us. So I read a lot, especially at Fidelity, and use research to sort of guide me along. So I think that's really helpful, especially in a time like this today, where markets are extremely volatile.
Yes,
right? So when there is a lot of fear, uncertainty, and doubt, as we mentioned, research is the one that really steadies your boat and gives you a clear mind to make investment decisions. So I've arrived at a conclusion based on certain things that I've shared today as well, things like valuation, things like where growth where growth is today, things like what is the focus of the Chinese economy going forward. Yeah, and I would say that generally, it kind of leads me to the Chinese consumer team as well, personally.
So, just a personal question now.
Yeah.
If your current self were to go back and kind of advise your younger self when you were just about to begin this journey into investing into the gold mine, what top 3 advice would you tell yourself?
I think
your younger self.
It's the same advice. There's just one advice is that when you go into the gold mine, I mean, using this analogy,
the right gear.
It is not uncommon for the gold mine to shake a little bit, right? And then you have the rocks start to fall, right? And so that is the uncertainty. So do you get out of the gold mine, right? So I guess the research will tell you, is this gold mine safe, right? Is the infrastructure of the gold mine well built for you to reach that end goal? Right, so once you have done the research or relied on other people to do the research for you, then the path should be clear. If the research says that this gold mine is a little bit shaky,
then better not.
Then maybe go to another gold mine.
There are many gold mines. Okay, very, very insightful indeed. Now, let me just ask you another one here about the China consumer. what would you say is the general difference between a China consumer versus a local Singapore consumer?
Wow, that's I would say
It's a very broad question.
it is a broad question, but if you were to ask me, I think one of the themes that, of all the three themes, right, premiumization, I think Singaporeans are into that. The second thing would be technology. I think Singaporeans are into that as well. But I think what we spoke about just now, the local brands.
I hear you.
Right. So now, if you go to China, I'm sure you will see many consumers using their Huawei phones, their Oppo phones. Right. But in Singapore, we are more global in the kind of products that we buy. I guess we can choose the best of all worlds. And actually, most of my friends now, they're also changing to Chinese phones. So we are going to merge towards the Chinese consumer, I think sooner rather than later. Yeah.
Okay, thanks for that. Now, before we end this segment of your very insightful sharing and as well as showing us the data, the details, because once again, at Fidelity, it's really about the research. And that's how you plan the journey and whether to go or not to go, or whether the gold mine is safe or not. I really like the analogy. Now, but Kaden, before we go, any final words for our audience online?
I think the final words would be, if you're investing into Chinese equities today, actually, for the matter of fact, even US equities today, we should prepare for a little bit more volatility ahead.
Yes,
there is a lot of fear, uncertainty, and doubt in the markets today, but it also means that there is opportunity.
Yes.
Right. So do the research, look in the right places, and have conviction. Right, and try not to pay attention to a lot of the fear mongering that's going around, especially in certain social media sites. Yeah.
Okay. Thank you so much, Kaden. Well, you heard the man himself. He talked a lot about how when there's volatility, there will be opportunity. He also talked about FUD, okay? FUD. Now, very quickly then, the first three audience that comments down and just says, what does FUD mean, okay? All right? Will walk away with 88 Tiger coins each, okay? The first three. Remember, the first three. Comment down in the section below. For our YouTube audience, unfortunately, we are not looking at the comments on YouTube, so you got to download the Tiger app, okay? Download the Tiger app and let us know what does FUD mean, okay? Kaden has mentioned many times.
Yes.
Maybe for one last time, why don't you share? What is FUD?
Fear, uncertainty, and
doubt. Okay, you heard it from the man himself. Fear, uncertainty, and doubt. And he always says in such volatile times, it's always also an opportunity. So once again, thank you so much, Kaden, for your time. Really appreciate. Okay, moving on to the next topic, it will be healthcare, investing in essentials. Once again, we've got Brian Lowe that will be joining us. So stay tuned. All right, welcome back once again. Different setup and still the same host. Welcome. We hope those of you that won the 88 Tiger coins, we'll let all the winners know, okay, for any of the games that I played with our online audience, okay. The Tiger Brokers team will let you all know through an SMS, okay, for all the prizes that you have won. Now, very quickly, once again, in the hot seat, we've got Brian Lowe. Welcome. Thank you so much for taking time to join us once again. Brian Lowe is the AVP, Financial Institutions, Franklin Templeton. And today we'll be talking about healthcare, investing in the essentials. All right. Now, very quickly, Brian, first up, can you tell me more about the demographic trends that will support the healthcare sector?
Yeah, certainly. And it's good to be back again. Speaking about healthcare this afternoon, a very important theme as we think about what are some of the opportunities that lie ahead in this very exciting sector. And definitely demographic themes are one of the key areas to watch out for, because healthcare is very much closely tied to the key demographic trends that we can expect to see. So if we were to pull out some of the content that we've put together, just to really talk about some of the themes, the first is definitely age, and definitely the inevitability of it. Right? We all age, the population ages. And when that happens, when someone ages, when you age, you would realize that you need more healthcare as well as better healthcare.
That's right.
Aging population dynamics will continue to drive this demand for better healthcare. And that's just one key demographic tailwind that is really going to be very much supportive for the healthcare sector. The global population is projected to cross 10 billion in just half a century's time, right? And that's a huge increase. And at the same time, the world is graying and living longer. So we're looking at two key things coming in together. We're going to have a larger share of the global population which are graying, and life expectancy is expected to increase. Now, this is just going to push the demand for more healthcare and for better healthcare, even as we look ahead in the decades ahead of us. The graying global population, it also means an increase in the volume of age-related diseases. As you age, definitely you're going to feel
more frail.
Definitely, and you're going to go for medical checkups a lot more often than when you are younger. So that means the volume of age-related diseases goes up, and there again lies the need, right, for healthcare services, and definitely the ongoing demand for it, as well as how the sector continues to address those needs. Unsurprisingly, people also spend more on healthcare, right? So yes, you're going to go more to the doctors for more checkups. That also means that a larger part of your expenditure is going to be put to healthcare, especially if you look at this very interesting graphic here. The moment you hit 65 and above, your yes, it goes up quite significantly, right? And I think this is also expected. Now, if you think about the graying population as well as the longer life expectancy that we're going to see, you know, this is going to be a large chunk of a lot of people's expenditure that will be put into this space as well. So really, this just speaks a little bit into some of the key demographic trends that we can expect as part of the graying population, longer life expectancy, people spending more on healthcare that we can expect, right, into the healthcare sector over the decades to come.
Thanks for sharing that. Now, Brian, you shared with us a lot of research about the healthcare sector. Can you share a little bit more about the R&D on this sector?
Yeah, and R&D is extremely important, and I'm glad you brought that up. What is at the forefront of healthcare is innovation. You need to think of better ways for patient care, better ways for treatments, prolong your life, the quality of healthcare. All of that can be traced to R&D into the healthcare sector. And if you were to take a look at some of the stats, right, and characteristics of this area, taken together, there is a pressing need for new and more effective treatments as this demand, this demographic tailwind increases the demand. So for this, R&D is key. What we've actually observed is R&D spending has seen a very strong increase over the past decade. So that is a good news, right? Over the past decade or decade and a half, the compound annual growth rate that we have been seeing is just above 10%. So the R&D spending is actually increasing year on year, and that is something that we like to see. It is also likely to grow, in part because of this renewed focus on healthcare at the back of the pandemic and the issues that it has caused. The focus on it, and this is actually good news for healthcare as a whole. When you think about how R&D is going to help discover new ways of treatments, new methodologies, better patient care, and I think that is what we are all hoping to look at as we age, right, as the population ages. So what are some of the key areas of innovation, especially when we think about healthcare? The key area of innovation within healthcare is in a very interesting and exciting space called biotechnology. This is a combination of biology and technology, and it's a very interesting and exciting sector that we are also very much interested in. So the key areas of innovation in the biotech sector is quite diverse, and it's also very much varied and exciting. So areas like orphan diseases. Now, what are orphan diseases? Orphan diseases are rare diseases. Okay, to name a few examples, Tourette syndrome, cystic fibrosis, right, and the likes of it, right? So these tends to be rare diseases, and we call it orphan diseases, right? Spinal muscular dystrophy, right? So all these are very rare diseases, and we are actually seeing the increase in R&D spending.
It's actually the highest.
It's actually the highest, and that is actually good news for patients who have unfortunately such diseases as well as medical conditions. So other areas that we are seeing strong R&D intensity: regenerative medicine, precision medicine, sequencing, gene therapy, geriatrics. So you can see that the diverse array of innovation within the biotech sector is really helping to push and extend the forefront of the healthcare sector. We have also seen the biotech space taking the lead, with new drug discovery platforms and technologies. Needless to say, the biotech sector has been so key in helping to come up with the vaccines as well as treatment methods for the pandemic. Right? And I think we've seen that really coming into play in the last couple of years. In addition to that, we have seen new leaps in the areas of oncology. So oncology is about the branch of medicine that deals with the prevention, diagnosis, and the treatment of cancer, right? And there are better ways to treat and identify cancer today, which makes the process less painful for patients. Another area that we are very much excited about, novel drug modalities, as well as gene therapy, right? To think about how we can cure and correct defective genes in our body via gene therapy, right? And helps to better fight diseases. So these are areas in the biotech space where there has been new drug discovery platforms and technologies that we believe will be so much more beneficial to patients as they continue to seek better treatment methods and better health care facilities.
It's indeed very heartening to hear that with all this advancement and innovation and R&D, more resources and funding spent to improve the lives of those affected, the patients, as well as to prolong the life of us in future. But the key thing here, and for the audience online as well, would be how does biotech have a part to play for investors? Maybe because some of us are already investing in this space.
Sure, and I think that it's a very good question, because biotechnology, as exciting as it sounds, as helpful as it sounds, as an investment idea or investment destination, might still be a bit of a foreign topic for a lot of our audience here today. So I hope to spend some time just sharing with you what are some of the key features and characteristics
that's why you're not
the biotech space. So I think we have a couple of content that we have put together for this as well. And the first thing I will note is that right now we are actually seeing within the healthcare space, biotechnology is leading the healthcare industry in terms of investment activity. Okay, so we talk about investing in this space. One of the key segments of the investment space is institutional players. So think about your hedge funds, your pension funds, and institutions that manage large money. We have seen a lot of investments from private equity and venture capital investors as well as hedge fund investors in the biotech and healthcare space just in 2020 alone, and we expect that to continue to move up as R&D becomes a lot more important. New areas of drugs and treatment methods continue to be discovered, as well as interest continues to be there because of the long-term benefits of what biotechnology can play in the healthcare space. We have also seen very strong track record for the biotech space, if you look over the past decade, the biotech space has actually outperformed the broader market across a wide variety of indices as well as market indicators. And this can be really seen over the long term, because in the short term, there could be certain sector-specific challenges that investors would have to go through. And I think that's part and parcel of investing in the biotech sector. Interestingly, we are also observing very solid fundamentals, for the biotech space. Sales per share, so this is just some of the characteristics we look out for. So sales as well as earnings per share for the biotech space across a range of sectors, as you can see here, is actually the top by amount, by quite a fair bit, especially on the sales side.
Close to double of the one just after
second,
it.
yeah, it's next to double. And this shows the strength. So we're not just talking about, what the biotech space can bring to the healthcare space, as well as patients, as well as investors, but we're really talking about good fundamentals that we have observed in the biotech space. More importantly, this is also made more interesting because stocks in the biotech space are trading at compelling valuation versus the broader market. If you look at just the S&P 500 Biotech Index, the gap between this specific sector against the broad S&P 500 market is very big. So this, if you're an investor, you're looking out for possibly large valuation gaps between sectors. I think the biotech space is actually one key sector that fulfills this criteria. Lastly, it is also trading at a discount compared to its own historical valuation. So not just is it trading at a discount compared to the broader market, against its own past, against its own history, we are also looking at just about close to 1+ standard deviation against its past 10-year average. So these are some of the key characteristics that I really wanted to share a little bit in more detail so that we can understand where we're coming from. But the last thing I would add is that investing in the biotech space means that we are helping, as investors, it means that we are helping to fund the research. It means that we are providing capital to a lot of biotech firms to help them with their research and development in helping to come up with better treatment methods, better drugs,
more innovative ways to solve current problems.
Definitely, because I think one of the observations that we see is that biotechnology firms, sometimes they have the will to do something, but they lack the funding.
I hear you.
And as investors, if we invest in this space, in a small way, we are helping the future of healthcare. And I think that is a key takeaway over the long term when we think about investing in the biotech space.
Very noble indeed.
It is.
I like one of the previous panel speaker. I think he or she mentioned that it's more than just profit sometimes. It's also about purpose and making that positive purpose to the sector in which you are investing in. Now, you shared with us a lot about the benefits, Brian. Now, what are some of the challenges of the biotech sector?
Definitely.
We've got about 5 minutes left, so just share with us the challenges and how can we go about such challenges?
Sure. And I think that there are challenges, especially when it comes to the biotech space. And this is also pertaining to the broader healthcare space. I think a key area of innovation in biotechnology is in the US, right? In particular, Silicon Valley. A lot of biopharma firms, small startups, really putting in those resources to help to come up with better outcomes for patients in general and for investors. I think one of the areas that would be a bit of a challenge is a bit more of an uncertainty towards drug pricing, especially in the US. On the one hand, companies, pharmaceutical companies, biotechnology companies, they need to have a certain price point so that they have profit to reinvest into their R&D.
And
at the same time, and continue the good work that they have been doing. At the same time, drug prices cannot be too high because everyone needs to be able to afford or have the ability to afford healthcare. So I think that that's one area of continued sort of momentarily uncertainty in certain parts of the market cycle or in certain parts of time. But I think that we are heading in the right direction. I think that there's a little bit more clarity into drug price and possibly drug price regulation. And this is something that both companies in the healthcare space as well as regulatory authorities do have to come together, have a part and come to play and to come to a correct balance into how we can approach this space. So I would say one of the challenges and possible risks is that maybe short-term volatility because of some of the changes in drug price or certain policies or actions that may come into the picture that may feel like it may not necessarily benefit companies, at least in the short term.
Okay.
So that's something investors might want to look out for.
Okay. So on that note then, Brian, help us understand with the challenges that you have shared, what are some ways investors like myself or even the audience tuning in, how can they better go about protecting themselves?
Certainly.
And their interests as well.
Yeah, definitely. So I would first start off by saying that investments in biotechnology tends to be, historically speaking, and I think we should also expect this, is that it tends to carry a higher level of risk than average. So investors who are looking into this space should be aware of that. You're looking at a sector or a subsector that carries a high level of risk compared to the broader market. So firstly, make sure your risk appetite is there. You have an allocation to that. Secondly, I do believe that looking at fund managers, right, professional fund managers who have been in this space for decades and having them manage those assets on your behalf might be a better move compared to possibly maybe picking a couple of stocks which may introduce a little bit more uncertainty and volatility into your portfolio. So think about maybe investing in a fund or a unit trust that is professionally managed rather than going into the market and doing it on your own.
I hear you. I think it's if you to draw the analogy to maybe learning how to pick up a new activity or sport.
Yeah.
You probably go to someone for training or whatnot. So in a sense, people will seek out a professional to help them do this job.
Definitely.
For them. Okay. Thank you so much for sharing with us. Now, before we come to a close on this segment, talking about healthcare, quick question, Brian. Just to ask you, for this topic of healthcare here, we've talked a lot about the US scene. Very quickly, in probably 1 minute, what about Singapore? How does that affect Singapore?
I think that I think Singapore has a very vibrant healthcare community. I think that you can see that we recognize, our country recognize the need. We are a developed nation. We have probably one of the higher rates of an aging population, especially in the developed world. So I think our country recognizes the need to make sure that we have the resources to support an aging population. And in certain parts, I think that we are doing a much better job compared to other parts of the world. If you look at healthcare innovation as well, I think that there are areas that we have an edge. So I would say that what we are seeing in terms of innovation, maybe in the US and in other parts of the world, I do recognize and see some parts of it being in Singapore. I think one of the areas which I'm quite heartened to see is that there is a lot of funding. There's a lot of grants, there's a lot of funding to fund such efforts. And so even at the top, there's support to make sure that at least the funding is there so that companies, startups even, do have the resources to do what needs to be done.
Thank you for sharing that. I think it's really, like you mentioned, it's very heartening to realize that actually in this little island state, there is support and funding even for matters as important as this. And we also hope that this is the case for many of you viewers that are tuning in from other countries as well. Again, this is not a case of just showcasing how fantastic we are here in Singapore, but really is to highlight the industry, the sector, the healthcare sector, biotechnology, and as well as to share with you the benefits and the challenges, really, especially if you're looking to invest in this sector. So like Brian mentioned earlier, it's really about also perhaps consider getting a fund manager to help you out in that. So very quickly, does Franklin Templeton do that?
Oh, that's a very good question. And the good news is that we do, which is why I think that I'm very happy to represent Franklin Templeton to share more of our expertise in this area. So our flagship biotechnology fund is called the Franklin Biotechnology Discovery Fund. The fund has been around since 2000. So we have more than 20 years
more than 2 decades
investment experience. Franklin Templeton's head office is located in just 1 hour south of San Francisco, and that's in the Silicon Valley area. So we are right in the action.
Right in the heart.
Right in the heart. Our fund managers always come to us to tell us so much more exciting stuff that is happening in the Valley. And that really is one of the key location advantages that we have in this space.
All right, you heard it from the man himself, Brian. look for them if you need fund managers, especially in this biotech healthcare space. So with that, that brings us to the end of our segment here, and we'll move on to the next segment, our final segment, and that's REIT's Outlook for 2020 by Nupur Joshi. They'll be joining us in the hot seat. So stay tuned for that. In the meantime, we're going to be talking about the Experience Store. Okay, like I mentioned here at WWTD 2022, it's not just work or talking about profits and purpose and being very into the head-amazing prices in these machines. Okay, these are the prices. Commission-free vouchers, $50 to $100 stock vouchers. We've got 888 Tiger coins to give away. Okay, so once again, Chinese New Year is not yet here, but because this is the year of the Tiger, all right, I'm Tyson here. I'm going to give you all the coins first, okay? So, but you need to go down to Tiong Bahru, okay? This is for our Singapore viewers, okay? And we've got Tiger Brokers merchandise limited edition, and last but not least, the Apple AirTag, okay? So these are some of the participating outlets in the area. Cafe hopping is something that's very popular now that there's less restrictions in our going and coming. Drips Bakery Cafe, Old Shifu Charcoal Porridge, Chapter 55, and Tien's. They're giving away free cups of coffees, gelato, as well as 10% off menu items. So head on there, check them out, okay? And while you're checking all these cafes out, okay, find the Tiger dolls, okay? Very important, because why? It will get you another chance of your shot at the claw machine, okay? Now, don't worry, fret not, for those of you that are more eco-friendly or haven't bought your EV yet. You can take the shuttle bus, yeah? Okay, we've got shuttle bus prepared for you 9 a.m. to 7 p.m. at Tiong Bahru Plaza. Pick up near the taxi stand, okay? So take a second. If you want to screenshot this, go ahead. So you get the details down. All right, let's give you another 2 more seconds. Okay, remember it's happening today and tomorrow. Yeah. And last but not least, we have been talking a lot about investments, the positive impacts, you know, and how it can benefit you in your life and your future as well. So without further ado, for those of you that are new to this, you're wondering where to start. Well, Tiger Brokers got you covered. Very simple. Just scan this QR code, head on down to our app. The Discover page is the banner right on top, and click there. Okay? Click there and read up more for yourself. Find out what is this unit trust starter pack, okay? Exposure to global equity and global bonds, and get your $50 off today. All right? So this is the QR code. I'll leave it up for another 3 seconds. Okay. And next up, we've got a very special video for you, okay? This is the first time we are screening it, or the second time, if I'm not wrong, okay? This is actually what's happening live at our Experience Store this morning. So sit back, relax, and feast your eyes on your own screen, and enjoy. Aha! Hi, good afternoon, one and all. It's me again, the host. In the hot seat, we've got Nupur Joshi, CEO, REITAS. All right, REITAS is REITAS Association of Singapore. I beg your pardon. Sorry. It's been a while. It's been a long day.
Sure.
Okay, thank you for your patience and understanding. Now, Nupur, before we go in and dive into today's topic, can you just share, maybe some of our viewers may not already know what REITs is. So can you share?
Okay, sure. So thank you, Mark, and thank you, Tiger Brokers, and thank you, audience, for staying in. And it's been a long day. I've been listening to some of the sessions, and they've been fantastic.
Yeah.
So, so coming to your question, I know we've talked a lot about, or the other speakers have talked about, REITs and their outlook and so forth. But so what is a REIT?
Yes.
A REIT is essentially a financial structure. So don't get scared. It's a simple concept. Basically, you have landlords. They own properties. They rent it out, and they get rent, right? So usually, in a normal situation, the landlord would keep the rent, pay off, use maintenance, pay the employees, and so forth, and that then the bottom line is his profit.
Yeah.
But in a REIT, what happens if you put your properties in a REIT, which means if some of the buildings have been put in this financial structure called a REIT, then there is a commitment on the part of the REIT manager that 90% or at least 90% of the taxable income, so roughly near the bottom line, will be distributed to unit holders. So the important concept is that, it's not a commitment from the heart, there it is, but it's basically a regulatory requirement. MAS requires it, right? We are regulated, the REIT industry in Singapore is regulated by MAS. And so 90%, at least 90% of the taxable income from a REIT is distributed out, which is why REITs are considered a steady, stable dividend instrument, you see. So you can invest in companies which also give dividends. You can have other companies, but there's no guarantee on what every year or every quarter or the board will meet and they will discuss, okay, we have this much spare cash, we use this much for investments, for our own internal investments, and we give out this much. But in a REIT,
it's fixed.
It is, the 90% is fixed. What the number works out to depends, of course, on how the revenues are, how the rentals are going, on the market outlook, and so forth. But from the bottom line, the taxable income, 90% has to be given out. And that's what makes it a very good instrument or a product to have in any diversified portfolio, right? Yeah, I hope that helps.
Yeah, I'm sure that probably has given quite a bit of insight to those that are wondering, what are REITs? Thank you so much for that.
Sure.
Now, very quickly then, let me ask you, how will REITs, be impacted by the prospect of rising interest rates in the coming years, especially in such volatile times, COVID-19, that changing the entire sphere of how REITs is, in a sense, as well as other sectors. So how?
Sure. Okay, so let me just again step back a little bit, give a little bit of the big picture context, and then we dive into the interest rates. So we talked about the fact that REITs are a yield instrument. It's a steady, stable distributions, right? So when we think about the returns from a REIT, the yield part is one component. Then there's the other part of a REIT return, which is the price movement, right? The stock price. So most of the time when we're talking about how REITs will do, we are really thinking, most people are thinking about, okay, will this stock go up or not, right? Or will it go down? So, but in a REIT, because the dividend part, which is the yield part, is such an important component, for a REIT, the way to think about returns is total return. That's the concept. So there's the yield part, and then there's the growth. The growth is the price appreciation, hopefully appreciation. There's no guarantees, right? So the yield plus growth equals to total return, right? So when we think about REITs, that's what we think about. Okay, so now interest rates, right? So what does that mean? So what happens when interest rates are on the rising trend, as what is the situation currently, is that first and foremost, there's a sentiment effect. Everyone just feels that because interest rates are going up, there can be other avenues to get that yield, right? So in other areas, correct, right? There are other fixed income instruments or whatever. So relatively speaking, the REIT looks a little bit less attractive.
Yes.
So that's the that's what I would say the common notion about, oh, interest rates are going up, REITs may not do well. Not to say that the thinking is wrong, it's just that there is more to it. Like everything else, there are more to it, right? So the concept that is often used or rather monitored to figure out how much the REITs will be impacted by interest rates is, the simple concept is called the yield spread. So what is the yield spread? You take the yield from the REITs. So for example, Singapore REITs, the average yield is around 6%. Okay, you take the risk-free rate of a Singapore government bond, 10-year government bond, currently it's around 1.8%. So we're talking about this spread from 1.8 to 6, correct? So it's around 4.2%. And then we compare this 4.2% to the historical. Is this higher than historical average? Is it lower than? And then we kind of try to get an idea of how REITs will do. So if the spread is still there, that means REITs are still relatively attractive, which means they should hopefully continue to do well. But if the spread has lower than historical average, then you may be a little cautious getting into REITs. So what is the historical average for Singapore?
I think that's that's a question that's on the viewer's mind.
Okay. So it's actually a little less than 4%. Okay. So the historical average is a little less than 4%, and right now, as I just calculated, the spread is around 4.2%.
Yeah.
So we are currently okay in one sense. Yeah. Not to say, we don't know how rapidly interest rates will rise. I think the jury is still out on that one. So something to be monitored, but as we sit down here today, we are not in a terrible situation. So that's part one of it. Part two of it is that, and that really depends, is impacting the sentiment, which is the stock price. Yes. But then we have to think about operationally for a REIT, interest rates are rising. How much does it matter? And what will it impact? It will impact their interest cost because all REITs have some loans, right? They have borrowings. So the interest cost will presumably go up a little bit, and it will presumably impact their operational costs, right? They have to maintain the properties, the building, exactly, right? So you have to pay you will see their operation expense line item go up, and so little bit. So in a real sense, these are the two areas in which the interest rates negatively or impact the REITs. But as I was saying, that's part of the story, right? So what's the other part of the story? The other part of the story is that we have to understand why are interest rates going up, right? And right now, the global environment is such, they're growing up because inflation is going up, and inflation is growing up because the expectation of growth is there, GDP growth, right? We are all expecting better GDP growth in 2022 compared to 21 and 20, right? So what does this mean? If growth is on an improving trend, that means the tenants who are using the buildings, who are paying the rent, are in a better position to pay up a little bit more. Exactly, you got it, right? So they are willing, so in a way, if their business is doing well, they don't mind paying a little bit more in their rent. If they pay a little bit more in the rent, the landlord gets a bit more, the REIT gets a bit more, and you as a REIT unit holder will also benefit more, right? So the rationale for why interest rates are going up is important, and right now we are in an environment where the expectation is that growth will go up. Of course, if growth projections go down, something again terrible happens, another wave that we are not foreseeing, then of course everything changes, right? So that's the other part. The other piece on the positive side is that if you look at the expectations or the forecast by the various equity analysts, right, for DPU growth, I say DPU, which is dividend per unit, which is basically the metric that is used to measure REIT's performance, right? So on average, most analysts are expecting 6% to 8% growth in DPU, in dividends per unit. Now that's a pretty good number. The growth, so we're talking about a yield of 6%, and then on top of that,
a growth,
right?
How many percent?
6 to 8% is what I think I heard the UOB lady say a little north of 6% as well. Yes. So roughly we are in that range, right? So which means, and of course we have to remember that the growth is there because 2021 was not a fantastic year. We were still kind of suffering, and of course
pulling through.
Effects. Yeah, correct. Yeah. So we hope 2022 will be better than 2021, so the base effect is there. The base is not so high, so the growth we hope is coming, right? And so the outlook is, I would say, cautiously optimistic. We hope, of course, we're all watching Omicron and so forth, So, right? And then the only other point I would add is to this whole, it's not, so if you see, it's just not an interest rate argument. We have to look at it in totality. Like, what is this whole macro environment in which REITs are functioning? So the other part is that all the reopening plays, right? So we're talking about if travel opens up a little, then hospitality does better, retail does better, and then, you know, if more people can go back to work, then the local retail is better, the office landlords are, you know, office goers, the office landlords have more tenants and so forth. So there are a number of potentially very positive signs. We have to wait and watch. So I guess that's the long answer to your short question of that what is the impact of interest rates? The interest rate impact is there. There are some negatives, there are some positives, but I would say cautiously optimistic that the impact would be muted for REITs.
You talked a bit about the office, retail, and hospitality properties. What are the prospects for REITs in these aspects, these sectors? Okay, especially emerging from 2021, like you mentioned, it wasn't a fantastic year. And what are these sectors in? The prospects for these REITs? Sure.
So I think one of the things we have to remember, and I think important for the audience also to appreciate, is that although there are 44 REITs in Singapore, listed on the Singapore Exchange, and out of these 44 REITs, they have properties all over the world. So in fact, there are only 5 REITs currently, 5 out of 44, that only have Singapore properties. So Singapore REITs are a very, very global product. We are a very global product. In fact, if you 45% of the properties owned by REITs are outside of Singapore. So we have to keep that in mind when...
And those that are internal just makes up a very small margin.
Right, and so it's...
How many percent is that again?
So 45% of the properties, if you go... I mean, each REIT may have from anywhere from 5 to 105 properties, right? It depends, correct? So if you just add up the properties, the property value, 45% of the property value of Singapore REITs are holding is outside of Singapore, right? So that's a huge one. And in terms of REITs, 5 out of 44. Okay, so we are really a global REIT hub. That's why Singapore is called a global REIT hub. But that's an important thing to remember. It's not just a tagline to throw out, but it's important to remember that because when we say what is the outlook for, let's say, office REITs, the office market in Singapore is very different from the office market in Japan.
Yes, definitely.
Compared and from the office market in, let's say, Australia to US to Europe, right? And our REITs have properties in all these markets, right? So now, if we really want to say what is the office outlook like, we have to go country by country, geography by geography.
Examine.
Yeah, so I think
just keep it local.
Right. So I think there are some few broad ideas which we can talk about. I think one of the big things that was weighing down on the office market was, of course, this whole work from home trend.
Yes.
And then we were hearing from the big tech companies in the US, especially that you can work from home like wherever. There is work from anywhere concept, and so we have then hybrid working, flex models. There have been a lot of these terms. Right?
As long as the productivity is there, we don't need you in office.
Right.
You just do it.
So I think the jury is still out on that one. And actually, the dynamics is different in different geographies. So I think what I have read and what I hear from the various REIT managers as well, because as an industry association, we are always talking to our REIT managers, right? These are the ones who are managing the REITs. So, for example, in places like where the commute is long, or home conditions are you don't have homes are small, you would rather go to an office and work, right? Whereas in places like the US, maybe you may have a slightly different way of thinking, right? You may think that I don't need to work in the city. I can work in a smaller town, and then the office market in some of the second-tier cities may do well. Right? And some of our US REITs with US assets, that's what they are doing. They are going into those areas where the demand is improving, right?
Rightly so.
Yeah. So I think it's important not to paint everything in one brush. So if you're thinking about office, look at the office REITs, look at where their properties are, which geography, and what is the dynamics in that market. And it's not only the work from home trend or the flexi work from anywhere trend, it's really a big chunk of piece of that is demand supply dynamics. So for example, if you look at Singapore, there is a shortage of, there has not been much of new office supply in Singapore, and that's keeping the office rentals steady. It's not making them, despite the fact that a lot of us, for 2 years, we've been sitting at home and working, but the office rentals, if you see, haven't crashed, right? Because the demand-supply conditions, the supply is not there that much. People now getting back to work. So I would say that the demand-supply, as well as how this whole work from anywhere trend evolves. Yeah. And the office landlords are, of course, they are smart people. They know these trends and they are also adapting. So you will find a lot of times that an office building, you will have the co-working spaces inside that office. Why is that? That's because their tenant themselves don't know. You may have a big multinational company, for example, who's your tenant. They themselves may not know how many of my staff will come back. Because the rules keep changing, right? So they will say, okay, I do what is called a core plus flex model. What is core plus flex? Core is like a fixed amount of space I commit to. Yes, I will take that much space. And then the flex is, and then if I have more people come in, I take a bit more. But to take a bit more, you need the space, right? Which is where the co-working people come in, co-working spaces come. So there's a lot of dynamics within each subsector. So I just talked about office, but we can talk.
And we haven't talked about retail, the industrial, and hospitality.
Exactly. Are we running short of time?
No, it's all right. It's all right. Okay, maybe just one last aspect. You pick one: retail, industrial, or hospitality, and then we'll move on.
Okay.
To the next
maybe I do a quick one. So I think so. Hospitality. I think we are all itching to travel.
Yes.
Hospitality, the big trend in this sector right now is that the scope is being widened from not just hotels and service apartments, but also to other kinds of lodging. So now the term is lodging. So student accommodation is a very hot sector right now in the lodging space. There is senior living housing. There is multifamily apartments. So this all comes in this what we call now the expanded hospitality, which is the lodging space. And I think as soon as we hear good news on the COVID front, things will improve. On the industrial and logistics have been fantastic performers, especially 2020, because we're all sitting at home watching Netflix and ordering online. But it's considered a secular trend, data streaming and Internet of Things and so forth. So those REITs with those properties should also do very well. In fact, if you look at the REITs, a lot of them are pivoting to buying more of industrial and logistics assets and data centers.
Wow.
So so that's it's always interesting to see what they are doing, REIT managers, because they are privy to the best to the best consultants who are advising them on the smartest stuff.
So in a sense, Nupur, you're telling us that the prospects, in a sense, are looking good.
I think so. I think so.
Generally.
I think so. We are at the start of 2022 and
final question. Okay, this one is going to be from the audience online. They ask, do you see office REITs picking up? Like just now you mentioned it's stable, even though the working arrangements have always been, in a sense, semi-work from home or work from home more often or not. But do you see it picking up in the coming year?
I think so. I think so. Unless, of course, that's of course assuming that Omicron goes away and nothing else, no other Greek alphabet,
no other
Greek alphabet comes along. So in that scenario, I would expect so. In fact, I have started going back to office ever since 3rd January. I've been going every single day, which I wasn't last year. So I would expect so. But of course, it's going to be different from pre-COVID. I think something has fundamentally changed about how we all work. And so we have to accept that there is that change. But as long as you trust that the REIT manager who is managing that office REIT has the wherewithal or the experience to navigate that. Nothing is ever constant, right?
It's ever changing.
It's ever changing. So it is, they are aware that, there is this trend. We have to kind of tweak our strategy a little bit. So I would think that if the smart, nimble office REIT managers should be able to perform well.
Okay. So in a sense, you heard it from the lady herself. In a sense, they'll be able to manage it, the fund managers of the office REITs.
Yeah.
And hopefully you'll pick up.
Yeah, I think the management experience is critical, right? And so anytime you're investing, I think first thing to do is to see the track record of management, how they have done.
Check out who's your fund manager.
Because
do a research first about them.
And there's plenty of information. Each REIT has I think REITs are one of the best investor relations websites. There's a lot of information. There's actually information on the REITAS website, REIT Association of Singapore website as well. And we constantly run webinars as the association, industry association. So if you follow us on LinkedIn, there are lots of free webinars that you can participate where you can actually interact with the REIT CEOs and ask them your questions directly. So next time it doesn't have to be me. It can be the person managing.
It can be the rest of her colleagues as well. Yeah. So you heard it from her. Audience, you can of course tune in to their webinars on LinkedIn, right?
Yeah, just follow us on LinkedIn.
Yeah, follow them on LinkedIn. Yeah. Once again, it's REITAS, okay? So REITs Association of Singapore. Right. Once again, thank you so much, Nupa Joshi, for joining us. Any last words? Just one sentence to our audience.
There should always be a place for REITs in a diversified portfolio. If you're young, even though your risk appetite is higher, please have some REITs because you will be thankful for it when you're older.
Very wise words indeed. Once again, thank you so much, Nupa, for joining us on behalf of the audience and the rest of the Tiger Brokers teams. It's been a pleasure having you, as well as the rest of the many esteemed speakers we've had.
Yeah, thank you so much, Mark. I enjoyed listening to all your previous sessions, and I'll tune in tomorrow to listen to the rest.
Pleasure's mine. That's right. On that note, ladies and gentlemen, yes, we are just done with day one of WWTD 2022. Investing today, investing tomorrow. Today, I beg your pardon. It's been a long day. We're finally done to our last speaker. We're done for the day, but hey, don't go anywhere because we're going to be talking about our experience store that is still happening right up to 7 p.m. and will happen again tomorrow, okay? And we've got many exciting topics and themes we'll be covering. Fundamentals of investing will be one of the main topics we'll be covering tomorrow, amongst many others. So you want to tune in same time, same place, wherever you're at. Okay, not just Singapore, our friends from overseas, whichever time zone you are in. Once again, just focus our attention to the slides. This is where our experience store is for our Singapore audience. Tiong Bahru Street, Yong Siak Street, I beg your pardon. There's a claw machine there. I've said it many times here and there. There's still time up to 7 p.m. Okay, these are the awesome prizes to be won. All right, and these are the participating outlets. And when you go around the participating outlets, I beg your pardon, always remember to watch out for the tiger doors, okay, to stand another chance at the claw machine. All right, there's shuttle service provided, 9 a.m. to 7 p.m., okay, and here are the details. Take a moment to screenshot it for those of you that have not already done so, and head on there now. Once again, our participating outlets have got free gelato to give away, free cups of coffee, etc., and 10% off some of them as well. Okay? And last but not least, today we have talked a lot about investing tomorrow, today, and what better way than to do that with our Unit Trust Starter Pack. So head on down to our app, okay, in the Discover page, the top banner there, the Fund More, okay, and click on there. Don't buy it straight away, okay? Be informed. If anything you have heard throughout today, it's always to do your research. So research that first, but here's the thing. This is a limited time offer starting from this webinar, okay? So head on down, the Discover page, the Fund More top banner. Click on that, read up more, and expose yourself to global equity and global bonds. And more importantly, get your $50 off today. All right? Okay, that brings us to the end now. A quick look at what happened at our experience store today. Sit back, enjoy, and I'll say a few words after the video. All right, congratulations to those of you that have stayed all the way right up to now and have not logged out. I'm giving away another set of coins, okay? This one is for all of you that heard what is the topic that I'll be talking about tomorrow, or not just me, I'll be interviewing, I'll be having esteemed speakers speak about the topic. I mentioned it before. Key it down in the comment, okay? The first 3 will walk away with 188 Tiger coins, okay? The first 3 people that comment in our Tiger app. For those of you listening on YouTube, you got to download the app, okay? If you want to win these Tiger coins. Once again, what is one of the topic, a theme rather, that we're going to be talking about tomorrow, okay? All right? Key it in, okay? All right, with that, once again, my name is Mark. It's been a pleasure hosting WWTD 2022 Day 1. I'll be back with you tomorrow for more. Cheers.